Catherine Allen.
Here.
John Bingaman.
Here.
Tim Jennings. Harold Lavender.
I'm here.
Mike Messina. Kurt Sommer. I think I heard it here. 1, 2, 3, 4.
Kurt, we can barely hear you, okay?
Okay, I'm here.
We do have a quorum
All right, great.
with 8 present.
Awesome. Do I have a motion for approval of today's agenda? So moved.
Second.
Okay, we've got a motion, proper motion by the treasurer, second by member Lavender. If we could have, is there discussion on that motion? We have a roll call vote on, accepting today's agenda.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
GFA Secretary Wayne Probst. Yes. Nick Tejas.
Yes.
Catherine Allen.
Here.
John Bingaman.
Yes.
Harold Lavender.
Yes.
Kurt Sommer. 8 affirmatives.
Great. Can I have an agenda to approve the minutes of our October meeting?
Also moved.
Second. Can we do all the minutes together? All right, could I have a motion to approve our October meeting minutes and our special meeting minutes from November 1st and 2nd?
I'll move approval of each. Both.
Okay, a second. All right, we have a proper motion by member Lavender, second by Madam Treasurer. Any discussion on the motion before the council? Hearing none, if we could have, Brent, we get a roll call, please.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
GFA Secretary Wayne Probst.
Yes.
Nick Tejas.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Here. Yes.
John Bingaman.
Yes.
Harold Lavender.
Yes, sir.
Kurt Sommer.
Yes.
Motion passes.
All right,
8-0.
Thank you. With that, we're going to turn to agenda item 2A and hear from Mr. Woolman, our acting.
Thank you, Commissioner. I will be brief. I know we have a lot on the agenda today. Total assets under management for the SIC were at $47.727 billion as of last Friday. Distributions over the last 12 months from the land grant and severance tax funds were $1.629 billion. At the end of October, the contributions from the land office last month were a robust $192.7 million. Currently, oil prices, New Mexico oil was at $72.16 as of last Friday. That's slightly discounted from WTI and compares fairly well to $74.56 as of a year ago. New Mexican production levels are also similar to last year, with 106 active rigs today versus 105 this time last year. Natural gas is valued at $2.63 per 1,000 cubic feet. That compares to $6.57 this time last year. Of course, that was driven mostly by the temporary price spike associated with the war in Ukraine. In operations, we continue to try and source several open positions, including a director of public equity, a real estate return analyst, a deputy general counsel, and of course the state investment officer. The council did have a special meeting yesterday to interview finalists. Our understanding is that the search process is in its final stages and that the council will make a public announcement regarding their selection in the near future. In external relations, internal legislative hearings are done. They're wrapping up this month. We have no more scheduled appearances. However, we have been requested to present to the Science and Technology Committee next interim for an overview of New Mexico private equity matters. Lawmakers are still hearing requests that the legislature consider creating yet another fund to invest in New Mexico companies, specifically in state companies in C and D rounds. Given the SIC's large program, the New Mexico Finance Authority's $50 million venture program, and the $75 million that the granted to the State Small Business Credit Initiative. That's overseen by NMFA and EDD. Some additional coordination on these efforts is probably appropriate, as well as assessing the effectiveness of all of these types of investments. One of the several noteworthy commitments the SIC made over the last year, it was into the New Mexico-focused Private Equity America's Frontier Fund. EFF will be rolling out an update on their new Roadrunner Venture Studio in early December. Council members have been invited to that event. If you've yet to RSVP and want more information, please contact me in the next week. We'll get you what you need. Lastly, I don't want to steal anyone's thunder, but I did want to highlight that we had our audit committee meeting last week and the exit conference with audit firm Moss Adams. Without detailing the results, we were again very pleased with the outcome, as we have been for the last several years. I want to personally recognize Brent Shipp and his investment accounting team of Nicole Gallegos, Andrea Cohen, Sue Griggs, and Norma Parra for excellent work. And that, Madam Chair, is the end of my report.
Council questions online? Hearing none, we'll go to agenda item 2B and hear from our CIO.
Very good. Well, thanks, Madam Chair. Good to see you all in the room and on the screen over there. Well, let me start out right away by saying, or introducing you to Ryan Eustace. Ryan, you want to stand up? Let me see you. So Ryan is joining our strategy group. And do you want to say, tell the group a little bit about that?
Yeah, started about 2 weeks ago. I came over from the Economic Development Department, where I was an economist for the department for about 7 years. I'm new to the investment world, so I'm eyes are wide open, my ears are open, I'm learning and listening, and I appreciate the opportunity. Thank you.
I am so excited because Ryan fills out the strategy group on our investment team, and just could not be more pleased to have that group full and ready to deploy all those resources toward improving our returns even further. You'll see some good numbers later. So very excited to have the Lisa strategy team full. We're still looking for 2 more, Starla Bennett successor, as Charlie mentioned, and then a new analyst in the real estate and real return area. We've got quite a few applications in on the real estate, real return, a little thin yet on Starla's successor, but we're still looking hard. Then in the legislature this year, you all approved our budget that we'll be taking. We'll be asking for 5 new positions on the investment team. We've grown to a size that we need an operations analyst to take some of those duties. Those duties now are split among our asset class directors, analysts, and Brett's investment accounting team. So we'll be able to consolidate all that under one person and hopefully get them the resources to get that job done. We're also large enough now that we need to do better at our cash management. Right now, that's all managed by JP Morgan and soon a piece by our treasurer. So we need more work in that area. We'll put 2 new analysts into private equity. That's an area where we're definitely understaffed, and we need a couple more investors there, and then 1 more in real estate, real return. That'll get us to a place I think we're reasonably sized relative to our assets. Of course, we can always use more resources, but I think that gets us up to at least some minimum level compared to the $47 billion that we manage today. So yeah, that's that. In terms of what's happening out there, at the August meeting, we discussed increased concerns over rising geopolitical risks. Unfortunately, that's come true. We just have been concerned. There's more happening out in the world today than there certainly was last summer, and it has increased risks around what could happen in the financial markets. Although the stock market and the stock market in particular doesn't seem to care. We're back near our old highs with the S&P 500 at about a 30 times Shiller P/E ratio. You know that number. We talk about it a lot. That's very high. Historically, when Shiller gets up at those levels, forward returns from the stock market underperform longer-term history. And then a measure that we've been watching here, I don't know, the past 2 or 3 quarters, it's kind of interesting. It takes a look at the stock market it puts the valuation into 3 different buckets. So the first bucket is the book value of the companies that make up the stock market. Now, that's an accounting number, that's not a valuation number or an economic number, it's just, so the book value of the S&P, then it puts, it buckets, the next 3 years net present value of the next 3 years earnings. Puts that in a separate bucket. That's an economic valuation of the market. And then everything else, so if you add those two things, everything else goes in a third bucket that the inventor of this measure calls the hopes and dreams component, the hopes and dreams bucket. So it's what we hope the stock market is worth outside of two pretty hard measures, the accounting measure of book value and net present value in the next 3 years of earnings. Right now, that hopes and dreams component is almost 80% of the stock market's value, and it's at near highs back for the last 40 years that they've got data. So it's back near where it was in 2007, again in 1998, 1999. There was a bump in 1987 that was fairly close, but almost 80% of the value falls into their hopes and dreams bucket. So it's pretty highly valued is what that measure is trying to say. The yield curve's inverted further. The 10-year is down 45 basis points. I think all that since we last talked. I think when we last talked, the 10-year was about 5%. The yield on the 10-year U.S. Treasury note is the most important interest rate on the planet, so we watch that very closely. So that's, the 2 years come down a little bit too. A lot of people look at the 10-year and 2-year spread to sort of gauge the shape of the yield curve. That's negative by 55 basis points. We've seen that as negative as 110. That's really unusual. The bond market spends less than 15% of its time in inverted territory. And generally, inversions generally lead to recessions, at least here in the U.S. However, many of the prognosticators out there are coming off of calls for recession. That's not particularly unusual. People have been calling for recession since the beginning of the year. The economists that work at some of the big investment banks and even the commercial banks, they can't hang on to a recession call for too long because the basic business of some of these investment banks is to sell investment product, and nobody wants to buy one ahead of a recession. So they can't really hang on to their calls for all that long. So we're seeing them come off of these calls for recession. Internally on our strategy team, we just think the business cycle is still a thing, and recessions are part of our economy, and we're still expecting to come along. If the business cycle has not been repealed, and there's a couple that have actually said it has, Janet Yellen, our current Treasury Secretary, said we may not see a recession in our lifetime. I don't think that's probably going to be the case. But if the business cycle hasn't been repealed, then our indicators are still valid, and a lot of them are flashing red, that we should head into lower growth and even negative growth, even if that's a shallow type recession. So our positioning in the portfolio, we like relative to those kind of expectations that markets are very highly priced at a time when the economy is slowing and may slow entirely into a recession. In fact, the land grant, and this is mostly a function of the huge inflows provided by the land office, is actually about 14% in excess cash and core bonds. So if you take the core bonds exposure that we currently have, subtract out the target that we have for that. Same thing for cash. The amount of cash we have minus the target there is zero. You get about 14%. So very nice positioning, particularly with cash and bond rates here, 4 or 5% ahead of what we think could be some rougher markets in recessionary conditions. Very good position for the fund. You'll see from numbers Marshall will show you here in a minute, performance has still stayed in there pretty good. Very good in the 3, 5, 7, 10-year time frames. Top quartile against peers, some of those time frames. Here a little bit closer a year in, we're slightly under, but still at the 9%. It's hung in there pretty good. Madam Chair, that's kind of brief of what's happening and how our portfolio is positioned relative to that. I don't think any questions yet.
Questions? Talk about this, the extra cash, is that like a thing? Is that something we've experienced before? What do we do?
I don't know the history beyond about 14 years ago or 15 years ago from studying reports a couple of years before I got here. I've been here. We've never been anywhere close to that. That's way above where we've ever been on cash, total cash and bonds overweight. Well, we're sitting on 4 or 5% yields on these securities, and the main reason that we have that kind of overweight is we just can't get invested in the private market. It takes, as you know, it just takes quite a bit of time to approve a fund and get that fund to draw capital.
Is there a question online?
Madam Chair, this is John Bingaman.
Yes, sir. Member Bingaman.
Yeah, just a question for Vince on the point that was just raised. I noticed we're also underweight in some of the public equities. Does that also reflect kind of a tactical call in essence related to some of the things you've been talking about? Or because I would think a lot of those public markets, like you should be able to deploy capital pretty quickly in terms of particularly those passive strategies, or how should we think about that?
Madam Chair and Member Bingaman, the report date that you're looking at there is the end of September, and markets have been selling off into that period. So it's not surprising that we have a small underweight there. We've gained back about 10% this month. So those numbers will be closer to the targets when you have a chance to look at the numbers at the end of November.
Okay. Thanks very much. And one other question, if I could, just on the staffing plan, the new hires that you mentioned. On the private equity side, is the intention to have one of those new folks dedicated to the New Mexico program, though kind of replicating the way it had been done in the past, or what's the thinking there?
Madam Chair and Member Bingaman, Chris Cassidy will still be responsible for that program. Obviously, I think some of the work's going to be carved out for that analyst, but Chris will still be the primary person on that one.
And the national.
Okay, thanks.
Who remains as director.
Right. Yeah, let's bring him.
All right.
Sure. I could wait till the investment committee report, but I think it's important. I'd like to take every opportunity I have to highlight the fact publicly that when I joined several years ago, we had 36 full-time employees and $13 billion of funds. Now we have almost $50 billion of funds, and we only have 30 full-time equivalent people. And I think we never say it too often how important it is that we figure out a way to staff up. And Secretary Props brought something up for us within the last couple of days that I found really interesting about a Court of Appeals case that might very well change how this part of our world exists. And maybe I could just ask him to would you take 30, 40 seconds, Wayne, and tell us what you told us?
Sure, Madam Chair and members of the council, the New Mexico Supreme Court recently ruled that, or upheld a district court ruling in a case brought against the Educational Retirement Board, and I should probably defer to the council's general counsel to describe the details of that appeals court ruling, but essentially the appeals court upheld a decision that the Educational Retirement Board has the authority as the sole fiduciary and sole trustee of that trust fund set salaries for its employees, both exempt and classified. So essentially, it removes employees at the Educational Retirement Board from the state personnel system. So that has significant implications, obviously, for ERB, potentially for the Public Employees Retirement Association, and depending on the reading of that ruling on the State Investment Council as well. And I think it would be a brave new world for us, but I think it's a brave new world that in the end would be a positive
Thank you, Madam Chair.
And perhaps, Madam Chair, at the January meeting, we could have a more educated, report on the potential implications of that ruling for our actual attorney.
I can give you 30 seconds now. As Secretary Cross mentioned, it was the ERB that brought a lawsuit saying, in order for us to be fiduciaries, we need to have some control of our funds with respect to staffing and compensation. Courts have agreed, it's currently with the Court of Appeals, as pointed out, that has appealed. I think that helped that they affirmed the lower court saying you have that authority. However, it could go to the Supreme Court still, so there may be some delay in terms of if that plays out and what the Supreme Court does with it. I really don't have much more to add. It's for flexibility of this board potentially to some of what Secretary Croft and Member Lavender were talking about, should they try to go in that direction.
Not to belabor that point, but just very briefly, I heard from my folks that there's a specific statute they were referring to that gives them statutory authority.
I'll say sort of that the three boards have very, ERB, the SIC, and PARA all have very similar language in their statutes. Without construing what their statute.
Madam Chair, I don't expect an appeal, but I don't expect an appeal.
Anything further on that? Awesome, thanks. All right, hearing none, we will turn now to, agenda item 2C, and here are September performance reports from RBK.
Thank you, Madam Chair. Morning, everybody. Today we have the third quarter executive summary in your packet. We start on page 24 of diligence, which, as always, gives you a brief overview of the capital market environment. On the bottom left-hand side of that particular page, you can see the trailing market performance for all the major asset classes. And as you look at that most recent quarter, I think you'll see a fairly stark contrast to the calendar year to date, the second column. So while we had a strong first half of the year, the third quarter certainly wasn't as accommodative. A lot of red ink representing some negative returns during that period. And this is true not just for your traditional risk assets or your equities, but also for fixed income as rates have continue to move up, and you can see that visually in the yield curve to the right-hand side, where yellow line represents the yield curve as of a year ago, and then blue is as of a quarter ago, and then the green line is end of third quarter. So no surprise there. We talked about the path of interest rates, particularly on the front end, on the short end, quite historic in terms of the Fed trying to rein in inflation, which was at times felt like runaway. So we certainly have made some progress there, although with the most current reading at 3.7 at the end of the third quarter, and that was held steady for October as well, still a little ways off of the 2% target. A lot of the repricing that we saw on the back end of the third quarter continued into October. Now November's been a bit more accommodated, had a bit of a rally. Vince mentioned that November has seen a bit of a bounce back, and that's helped with some of the relative allocation exposures, and should at least quarter to date for this first fourth quarter, the first 2 months now that we're getting close to the end of November. Traditional assets with equities up about 5%, fixed income also positive. We've seen those rates coming down a little bit, or at least taking a bit of a breather, about 2%. With inflation coming down, I think it ties into the opportunity cost that Member Bingaman and others had mentioned. When you're getting 4 or 5% on essentially your cash and very, very safe conservative fixed income, as inflation drops below that, you can start to earn a positive real yield, and that does reduce your non-cash drag on the portfolio and buys you a little bit of additional flexibility and time to deploy those in performance with your overall asset allocation. Much better time to be positioned the way you are than even 6 to 12 months ago in terms of the strong inflows, being able to put those to work. No shortage of uncertainty. We've seen that with all the volatility, even just the last few months. The geopolitical risks, I think, are there, but there's a number of other ones that we've talked about in prior months. I think just the last comment I'll make, as you look at your third quarter numbers, I think you'll notice that you have some meaningful downside protection, particularly relative to the broader market when you compare just the broad benchmark. And then also really making good use of your diversification. Diversification when markets are moving straight up doesn't always feel that helpful. But when you have this kind of up and down market that we have been having, it's been really a great addition and something that obviously is structured to withstand. So you'll not only have cash, but most of your non-public asset classes also being additive to that result. So I'll stop here. Happy to take any questions or comments before Marcia gives you some additional.
Go to page 27, we'll start out with asset allocation, largest driver of the returns for the permanent fund. As you recall, in this year, there were some asset allocation changes, and from that, some interim targets were set because of cash flow, and because it takes a while to get two-year targets, because most of your allocation changes increased allocation to private. So it will take a while. So what is reflected here is your current versus your interim target. And so it takes a while. As I said, you can see that you're within ranges for the most part, definitely on the land grant, not quite there on the severance tax, but could be now, as Vince said. This is as of September. You go to the next page, you can see the other funds, and you'll see off interim targets on many of these, and these funds had significant allocation changes within the year. It will take some time. You'll see the conservation legacy total funds deposits at the bottom right-hand side has been added, and that is at the end is all in cash. It will take a while to deploy that. And also on early childhood, some significant changes to the allocation there. So we will continue to monitor where you are against your long-term target, but we're reflecting the interim targets. We go to page 30. You can see performance. And this executive summary is a tool for you to follow how you're doing against the targets that you set, the objectives you set in your investment policy. So the land grant has performance expectations to benchmark over that 5-year period. You can see it has by 2 basis points, so you're in compliance there. Severance tax for the 5-year period has underperformed, and we've discussed this over time, that this is not kept up with the land grant. It does have the in-state program in the severance tax. If you look at the bottom, you see the actual returns. So as both Vince and Matthias mentioned, it was a difficult quarter. You can see a negative return for the quarter, but if you compare that to the land grant policy and, in fact, to the severance tax policy, you outperform both of those benchmarks. Longer term for land grant, you can see across the board outperformance against the benchmark. The benchmark is shown in italics below. We're showing growth in net. The land grant has done a very nice job of outperforming its benchmark. Severance on the shorter term, 1 year, actually outperforming, but longer term, it has struggled to beat its long-term benchmark. And I just, on the next page, page 31, to break that down into an attribution. As we saw, your return for the quarter, your actual return for the quarter for land grant was a negative 0.98. The benchmark benchmark was down more, down 1.16. So where did that difference come from? Why did you do better than that benchmark? So tactical asset allocation, that is in the yellow bar, that was a negative contributor. That's not really, your staff is not being tactical with your asset allocation. So it's just a matter that you're not at your allocation. And for the 1 year, that was a bigger detractor, because remember, you're getting a lot of cash in, and it takes a while to deploy that to your target. So it was a detractor for the quarter, a mild detractor. Not being structured exactly like your benchmark was a mild detractor, but look at your manager alpha made up for that. So you had outperformance for the quarter. Go to the next page, it's the same information for land grant for the year again. The land grant beat its benchmark, and again, it beat it because your manager value add across the board was a positive 1.27. Here you'll see, though, on the, where it says taxable, not being at your benchmark, it was a bigger detractor for the year. Again, having that cash and not being able to deploy it to the asset classes as quickly as you could if it was public market. We have the same information for severance tax, so it's pretty much the same story. But if we go to page 35 and 36, this is showing for a calendar year, on a calendar year-to-date basis, for each, for the total fund at the very top, and then for the individual funds following on this page and the next, kind of the cash flow look. So for the total fund on page 35, you began the year at 38.3, but look at that net cash inflow. The total inflow, net cash inflow was 6.6 billion. And then you can also see, even though the quarter was negative, you had a gain total fund. So that's for everything. Right below that, you can see the same information for the land grant and then the other permanent funds as well. So strong cash inflows, and by the negative quarter, positive. Now going to page 39. Your policy doesn't have an objective for your peers, but each quarter we do look at how you performed against your peers. It's good information to have. You're not like your peers, but we do show this information because it's beneficial. So again, then this is for the land grant on page 39. Land grant returned that 0.98 for the quarter, and your policy was down 1.16. We've already discussed this. But the median plan in the universe of plans of public funds greater than $1 billion in assets, it was down 1.94. So you are almost 100 basis points better than the median plan. So for that quarter, you ranked in the 13th percentile. That's good. 1 year below median, but if you look out 3, 5, 7, 10, you're sometimes in close to top quartile, but this 10-year in the top third. So relative to your peers, your positioning has been beneficial, and you have that top third percentile rank. Remember, when Vince came on board, and we'll show this in a minute, the SIC had experienced top decile, bottom decile, top decile, bottom decile. That consistency of outperforming or being above median has paid off for you. You don't have that volatility of return. That is shown on page 40. A lot of information, a lot of dots. This is looking at rolling 5-year peer ranks versus this public fund universe of plans greater than $1 billion. And again, the goal was to have a 5-year rank above median to get that consistency, and you can see for the most part, you've been above that median, and recently you've been very close, as I mentioned before, to that top quartile position. That also translates, we think, importantly on page 41, looking at your risk-adjusted returns. This is looking at the 5-year peer rank of Sharpe ratio, again on page 41, and you rank in the top quartile against your peers. So that's very nice positioning on a risk-adjusted basis for the SIC, and this in particular is for the land. information for severance, tax on the next page. So let's go, to page 44. And looking on a risk return basis, the top, left-hand side is looking at this 5-year period. They're on top of each other, but your land grant total fund, return for that 5-year period was 6.08. The median plan returned 5.26, so you did better than the median. You captured 115% of the median return, and you did it in far less volatility. You only had 76% of the volatility. So the land grant standard deviation was 9.43 versus median was at 12.41. So again, that's only 76%. That puts you on that northwest quadrant of this risk return chart where you have above median return at below median risk, and that's exactly where you want to be. You see that for the 5 years, the downward triangle, the green diamond is a land grant, and the red circle, or land grant total fund is the green dot that you can't see, and severance is the blue circle. So land grant, as we know, did better, but both having low volatility compared to peers, and land grant outperforming peers. We have the same information for the 10-year period right below that. And again, the same story, falling in the northwest quadrant for the land. Questions on that? And quickly, I know you have other reports, so I'm just going to cover on asset class performance. Going to, let's go to page 49, your U.S. equity asset class performance. Just to mention, as we get there, there were no manager changes, no manager terminations, no manager news to report. So on page 49, you can see that for the 5-year period that your policy has you benchmark, the objective is to outperform the Russell 3000. For the 5-year period, if you did not do that, you returned 8.61 for the 5 years, and the benchmark was at 9.14. So you'll see more recent time periods outperform that on both a gross and net basis. It's interesting to look down below, we look at, within this composite, we look at large cap and we look at small cap, and it's notable that you can see that the large cap over this time period of 10 years has outperformed small cap. Historically, we always said the small cap is higher volatility, you expect small cap to outperform really since post-financial crisis. That has not been the case, so the large cap component has outperformed small cap. But this has been repositioned, and we expect that no to become a yes, based on the track record we've seen in the shorter term. With that said, if you go to page 50 and look at this risk return chart, you fall in that northwest quadrant again. Your U.S. equity composite for that period was above median, so you didn't your benchmark for that 5-year period, but you didn't median. So it was a time period where active managers had a difficult, or portfolios had a difficult time beating the benchmark, and neither the less volatility. Let's look at the same information for the non-U.S. equity composite by going to page 54. Again, no manager changes, no manager terminations, staying close to that interim target. Here you can see on the shorter term, you've slightly underperformed. Calendar year to date, you're right on top of your benchmark on the growth of fees. The 1 year, you're ahead of it both on the growth and net. So longer term track record for non-U.S. equity has been outperformance. You can see the yes there for that 5-year period and the 50 basis. And that is reflected also on page 55. Here, you're not in that northwest quadrant, but you have median volatility at slightly below median. So you beat your benchmark in non-US equities, but you haven't kept, you're not outperforming your, the median. You're slightly below median performance for that 5-year period. And last, we'll do public fixed income, and that is on page, the top part of page 59. Nikita will be here to talk about the private composites, but your public, fixed income composite has beat its benchmark of the U.S. Ag, Bloomberg U.S. Ag, and you nicely for the 5-year period, you beat it by 121 basis points. So you see the yes there, and that's consistent with the, outperformance. Madam Chair, we'll take any. Marcia, with you. Can I take you back really quick to, page 30, you made a statement about severance in, 65 days off the agenda. That's because the New Mexico program is in there? Well, that's part of it. I mean, we could go to, page 30. Well, that's on the attribution. That's for the land grant, and if you go to page 33, you can see the severance that you mentioned. Yeah, so this, after, I didn't go over the attribution for the severance. You can see that for the quarter, 1 year. On page 33, this is looking at that severance information, for an attribution, where you can see you outperformed, but most of that outperformance came, from the allocation, and then next from not being right at your target. So you see manager skill here. This, includes, in this report, we lumped the in-state with the national, and if you compare the performance against the land grant, you look at, let's just look at the example. This is not a perfect, but if you look for the quarter, we're showing manager value add is 0, for the quarter for land grant, and we're showing a negative, a minor negative for private equity for the severance. And the difference is land grant doesn't have any of the private, the state in it. So it's a factor. And it always got to be a factor. I guess I never, put the two together that way. And in the flash, we'll do better when we show the flash on a monthly basis. We never go back to the page that shows the national. Could you point that out? We will start pointing that out. Okay. I'd be curious. So we're going to start with our quarter 2 PMRs. Go first with Mr. Lawson and Nikita for private credit. And item 2.
Thank you, Madam Chair. So joining me on this performance report review is Tad Ferguson from Nikita. Tad, I have your here.
Yeah.
Oh, you've got it. Good. Thank you. So we're going to keep our comments relatively brief given the long agenda today. Let me just get started. So the private debt market continues to grow, and on several fronts it continues to take share from public debt markets. SIC is underweight in its private debt markets allocation. We've been making solid progress on our pacing goals, but we're not going to rush. Earlier this year, SIC approved staff's recommendation to restructure debt market investments to group liquid public market exposures into the public markets allocation, private markets into the private markets allocation, and to begin the redemption of the majority of SIC's hedge fund exposures. So within, if you look at the private debt allocation, if you exclude the legacy and those remaining exposures, that improves performance by over 300 basis points. So I believe we're headed in the right direction. We continue to leverage our improved focus and scale to improve structural example of that in today's golf commitment recommendation. So with that, I'm going to turn it over to Ted.
Thank you. Good morning. Ted Ferguson from Makita, and appreciate the opportunity to come and present in person this morning. Just as a reminder, this is the 6/30 private credit performance report, as will be consistent with the other private market reports. We receive information from the private market managers on a delayed basis, so we're reporting on a one-quarter lag relative to the RDK performance report that was as of 9/30. But just starting out on page 69 from a high level, as of mid-year 2023, the program is constructed with $7.1 billion of commitments across 48 partnerships. Approximately 68% of this was drawn down and invested, and the program had a remaining market value of $4.3 billion. This represents almost 10% of the total portfolio, so progress towards the long-term target of 15%. But as mentioned, continued commitment activity and progress need to be made on a disciplined and consistent manner to reach and maintain that target allocation over time. As mentioned, there was a structural review earlier this year for the fixed income portfolio, but the program originally had inception of June of 2012, so it's a little over 11 years old, and there's been an evolution of the program and some different exposures within the program. But a primary outcome of that structural review is to really orient towards this program towards the private credit markets, where there was some more hedge fund and public market exposure historically in that. Yes. So, and a lot of this report will kind of try and orient towards this new structure going forward, and that's primary components I'll try and hit as discussing today. But as of mid-year 2023, the program has generated a net since inception IRR of 5.4%, and this is relative to the new adopted benchmark of generated at 5.7%. The new benchmark is the S&P Leveraged Loan Index plus 200 basis points. And that's more of a private market-oriented comparison. So there's a little bit of a benchmark mismatch compared to those legacy exposures, but we're trying to orient towards the go-forward types of exposures. But as Tom mentioned, if we just look at the core exposures, private market strategies going forward, we generate a very strong 9.1%. So on the next page, page 70, I'll expand a little bit more on the go-forward type strategies that were adopted in the structural review. Here we've got 6 strategies. The top 4 are what I consider the core strategies going forward that were, adopted in the fixed income structural review. That's direct lending, asset-based, special situations, and diversified. These each have target allocations of 15 to 30%. And currently there's some deviations relative to these targets, given that this is an evolving program. But underweight the direct lending and asset-based, within target ranges for special situations, and slight overweight diversified. But you'll note on this page, the largest exposure is a 37% exposure to what was identified as liquidating. And these are the hedge fund exposures or public fixed income exposures that either redemptions have been put in or there's going to be a reallocation of assets. So those exposures are expected to come down relatively quickly as we make progress toward these other long-term goals of the private credit exposure. On page 71, just a little bit more detail on each of these strategy groupings, your traditional private market metrics. But I'll just orient your focus towards the right-hand column for the since inception IRR for each of these categories. The top 4 strategies are the go-forward strategies that have each been very additive to overall results, generated about 8% or better in each of these strategies, while the legacy and liquidating have been more to 3 to 4% range. This isn't a negative comment on those exposures. They have a different role within the portfolio. They're different exposures, but it's just more to orient towards why we're focusing on the private credit markets going forward. Also note on this page the unfunded commitments. You'll see the top 4 categories are about $2.5 billion of unfunded commitments.
Let's figure out.
Unfunded will go to the strategies.
Okay. So, okay, now I. You can keep. Well, you want me to keep this here?
Please mute.
Please mute.
I'll jump ahead to 73. We just outlined some recent commitment activity over the past couple of years and highlight our kind of go-forward activities. Here we're just looking at the 2022 and 2023 activity, and just really want to reiterate some of the commentary that's been, takes time to hit target allocations and consistent activity. So you can see the 2022 commitments aggregated to about $1.2 billion. We've already committed $1.6 billion year-to-date in 2023. We're on pace to hit about $2 billion. So we really expect to increase the annual commitment pacing and increasing our average commitment sizes to partnerships as we are striving on a, disciplined and consistent manner towards that 15% target. But also want to reiterate and focus that while we are committing across strategies, much of the activities are targeted, year-to-date towards those underweight segments of the asset-based and direct lending that I mentioned previously. So the other segments in the report really kind of outline the cash flows of the program and more detailed information on strategy or vintage year IRRs. But given the full agenda and sake of time, I really wanted to pause here and stop with some summary comments just to reiterate. This is an evolving program. We've got some new private, the structural review really reoriented the program towards the private credit markets, and there's going to be ongoing progress to make that achieve those strategy targets on an underlying basis and at the total portfolio level basis. So we plan to do that in a very consistent and disciplined manner on a go-forward basis. I'll pause there for any questions. All right.
Page 80, part of your presentation also?
Yeah, that's graphically presentation, yes, on a market value and exposure basis.
Page 81, what is open-ended based on for the vintage?
Yeah, so open-ended, those are more evergreen-like structures. So much of the activity are closed-end, finite term, where they have like a 7-year term where you expect to get all your capital back. The evergreen or open-ended structures are one where capital can be redeployed. And I know Mary's had a lot of discussions with, focusing on multiple and recycling capital. So those kind of structures, the blended structures kind of achieve that, but the evergreen allows to maintain that recycling of capital and maintain that exposure within the program.
Thank you.
Any more questions? Thank you.
Thank you.
We'll hear from Mr. Cassidy and Mercer for both our national and civic. The items.
So I'll be brief. I'm joined by Richard Pugmire, who will take most of the discussion on the National Private Equity Program. The program was up 2.3% for the second quarter and up 4.6% for the year. This compares favorably to the Burgess Private Equity Index, which is up 1.6% and 1.1% respectively. So we're still seeing relative performance. I think it reflects the fact our portfolio is skewed towards buyouts and profitable growth funds. Venture capital continues to weigh on index performance. Distributions on the portfolio remain above average. I think it reflects we have a pretty mature portfolio. Good companies are still being sold at good valuations, and we're add to the portfolio into the fourth quarter. And I'll pass it to Richard.
Thank you, and good morning. I'll start on page 93 in the materials with the slide titled Performance Overview. And we're covering the Q2 2023 performance today for the national program. Now, I'll be brief because there wasn't really that many changes quarter over quarter in the National Private Equity Program. For the quarter, we saw a gain of 2.3%, which is actually similar to what we saw in Q1 as well. The one-year return is a positive 4.6%, which is outperforming the broad private equity benchmark on a one-year basis. And as Chris mentioned, manager performance and the allocation of buyout has a lot to do with that, because we've seen a lot more volatility and losses in venture capital on a one-year basis. Over the longer time periods, we show favorable performance with the 3-year at 22% and the 5-year at just under 16%, which is mainly driven by those vintage year 2011 and after portfolio, but the legacy portfolio is almost all realized at this point. But the legacy portfolio still has some weight in the longer term returns, like the 10-year return, which you can see the overall return is 13.8% versus the 2011 after at 16.8%. From a since inception standpoint, the 2011 and after is just under 17%.
The overall performance for national private equity is at 12.5%, which equates to a gain of just over $4.1 billion. And from an activity front, we have made $1.1 billion of commitments to 14 managers, and we have 3 new commitments in the national program on the agenda today. You skip ahead 2 slides, which highlights the quarter-over-quarter performance for the net asset value. The net asset value actually increased by $125 million during the quarter, and this graph shows the drivers of that change. We had a net contribution during the quarter of $41 million, which is different from the last quarter where we actually had more distributions than contributions. We also saw gains across all strategies except venture capital during the quarter, and venture capital just had a small loss. A lot of the newer funds that we're making commitments to in venture capital, it's still too early on the performance front, so a lot of that is the legacy venture capital that was done before 2011. And then also on the cash flows, I wanted to mention through mid-November 2023, contributions have exceeded distributions by $21 million, but we've continued to see healthy levels of distributions come in to partially offset those contributions that we're getting from the new commitments. And it's also a sign of, we continue to get realization, sign of a healthy and more mature portfolio that we have. On the next slide, covering benchmarking, diversification, there hasn't really been any significant changes, so I'll conclude my remarks on the national program there and happy to answer any questions.
Questions from council?
So on the New Mexico program, a little bigger change this month, reflective of this portfolio. Discussed in the past, is more concentrated if you look at an underlying basis. So as some of those positions move up and down, you see a bit more volatility, and it's reflected this month, past month. And I will start on page 113 in the materials with the performance overview again. And the New Mexico program did have a difficult quarter. It was really driven by negative performance in the co-investment funds, which you can see in the table at the bottom of this slide, which the co-investment funds in the quarter were down 23%, which is basically a mark-to-market on a new financing round for a company in there. And this impacted the since inception return. So the since inception return is now a negative 0.3%, and which equates to a $16 million loss. And we've always talked about with the New Mexico program 2 things to remember. One is it is fairly concentrated in one manager and in a few large companies. And we've been working on diversifying exposure there, but it takes many years to diversify exposure. And some of the new fund commitments that we're bringing to you, it takes years for them to draw that commitment down and invest. So we are working on diversifying the portfolio. And then the second thing is it is more venture capital centric. And venture capital has just been hit harder over the last few years in what's been happening in the broader economy. And so we have seen the overall performance of the New Mexico program have negative performance compared to the national program, which has maintained positive performance. When you look at the 3-year and the 5-year period, you can see that the theme is really the negative performance from the co-investment funds, but it's been slightly offset with positive performance from the newer fund commitments and the recovery fund. And since inception, the newer fund commitments have generated a 12.7% return or a $44 million gain, but much of this value right now is unrealized, so even that gain can be volatile. And from a commitment activity perspective, we've done $147.5 million of commitments to 5 managers in 2023, and we have 2 that are being presented on the agenda today. And I'll move forward 2 slides to the net asset value change, and we did actually see a decline in the net asset value. The decline was $25 million, and if you look at this chart, we are getting contributions in, more contributions than distributions. You may recall that at the beginning of the year and last year, we actually got quite a few distributions from the New Mexico program as the recovery fund had loan repayments coming in, and those have slowed down in Q2. And we're now getting the capital calls from the newer fund commitments. And then you have the loss that came through mostly from the co-investment funds during the quarter, which really drove the decline in the net asset value. Looking at the economic development statistics as well, which starts
in 2 slides. There wasn't really any significant changes, quarter over quarter. There wasn't any new New Mexico companies added during the quarter, and the jobs numbers slightly increased, expenditures slightly increased, but there wasn't really any significant changes. So I'll conclude my remarks there on the New Mexico program and happy to answer any questions.
Page 117, it mentions that there's 5 companies that are no longer located in New Mexico. How does that come about with the New Mexico fund?
So the funds that we go into, they basically enter into a side letter that they'll invest or cause others to invest whatever the commitment amount is in New Mexico-based companies. But what happens sometimes during the life of the company is the company may move to another headquartered region for whatever reason. You know, maybe they started in New Mexico and then they moved to California, their headquarters to California, and so that's what that number reflects. And companies have moved during the life of the company and it being in the fund.
So what could we do to help New Mexico businesses be more sophisticated about funding, more sophisticated about getting investments? What role could the SIC play in that, in creating mentorships or whatever needs to happen to make a more sophisticated investment community?
Yeah, so I mean, that's part of our New Mexico program strategy, actually. We want to get high-quality managers, experienced managers into the ecosystem, spending time with entrepreneurs and training them about what it takes to be a company, to establish, you know, formal procedures that venture capitalists are looking for before an investment happens. What kind of board governance do you have to have? And so that's something that we've been focusing on with the high-quality managers that we're targeting in the New Mexico program to really provide that education for the local ecosystem.
So is it something either working with economic development, or is it something the SIC, for instance, you as investment people could hold some kind of a regular event that would help them? Because I understand we have great technology, we've got great scientists, not so great business people. And a friend of mine, the head of the Council on Competitiveness, did a measure of places around the country, including Albuquerque, and the 2 issues were not enough venture capital or seed capital or money, and secondly, not the sophistication of having done Series A or B funding and really understanding growing a business. And I feel like if we have a responsibility at the SIC to help New Mexico and help New Mexico businesses, it's not just money, it's education. So what do you feel like the SIC should be doing?
Yeah, I mean, you know, last year we did the Frontier Fund, which established the Roadrunner Studios, which actually helps incubate companies and, you know, might only have one entrepreneur that has an idea, but they're then bringing in outside expertise through their network to provide that type of knowledge. So I think the SIC is actually doing quite a bit through the New Mexico program and the commitments that you're making. I mean, there's always things that other entities can do in the ecosystem to help. You know, universities could train up about, you know, what entrepreneurship is and how to establish a business and just basics like that will help in the ecosystem. But I think from the SIC perspective with the New Mexico program, I mean, that's kind of the role that we're focused on with the New Mexico program.
Are we being welcoming to these businesses? Are we not being rude and turning them away? What are we doing when we have people come talk to us?
Well, we ask the managers to get feedback. I mean, there's always going to be, you know, in venture capital, there's always going to be more no's than yes when you're evaluating companies, just because there's a lot of different companies out there. So we've asked the managers to actually provide feedback back to the entrepreneurs of how they can improve. So that's an important part of, I think, of the development of the ecosystem.
Do we see some of that? Is that appropriate?
Yeah, we could ask the managers.
Anything company specific, they'll be reticent.
Right.
But yeah, I think,
just more general.
yeah, I think the hard part is, as Richard said, there's more no's than yeses, and so we want to have critical feedback. But venture capital fits into each part of the ecosystem. So there's company creation and pre-seed, which Frontier Fund and Antler, which over the last year. We have a good group of local managers on the ground that can meet with companies. This year we brought Tramway relatively recently, and today we're going to introduce a new emerging manager, a gentleman who is a successful entrepreneur who moved to New Mexico to spend the rest of his life on climate technology. And then downstream from there, including today, we're talking about a group called Coastal that invests across all those stages. And I would say, I think kind of the difficult part is, the reality is some companies won't hit those milestones and won't funding, and it's just natural. And I think that's the hard part for us. I think creating the program is not necessarily being rude or mean. It's the reality of kind of the business. And recently there was quite a big milestone for the community. A company called NTX Bio. It's this large Series B, very high quality firm out of Boston. It's a big thing for the ecosystem. So we are seeing some success stories, but I think it's I think it's in line with the reality of venture capital, and what we're trying to one of the things we're trying to achieve is more company creation, so there's more chances as you work through that chain that we're creating more NTX kind of results. Because the reality, I think, unfortunately, is the way it works is a decent chunk of the companies started may not work. It's pretty normal. World-class venture capitalists, is right 40% of the time. So, I think...
And there's an education that comes from failure, too. I mean, that's why we have focused so much on company creation and getting people off the ground, through a pre-seed or seed-type funding, where, maybe that idea doesn't work, but their next idea is going to work. But they learn lessons through going through that failure that they then apply for their next company. So there's a lot of benefits that can come.
So is it your opinion that we have robust pre-seed and seed opportunities for New Mexico?
Not a lot. I mean, that's one of the reasons why we focused on groups like Antler and groups like the Frontier Fund to create more companies at the pre-seed.
Madam Chair?
Take a look at beefing up a robust seed program, just opportunities for companies on the front end.
I think it'd be good for us to look, for the council to review more succinctly what we're doing in New Mexico, what the opportunities are, what targets. I've come out of the cybersecurity field. I know there's a lot of opportunity of companies wanting to move out of Silicon Valley to other places. Do we have incentives for the cyber companies to come here, or AI companies? So I think it's something that we need to continue to discuss, how you all are working with companies and how we can help educate them and how we can leverage other private equity or VC that we invest in that have knowledge that they might help us.
Good suggestion. Madam Treasurer, and then I heard you, Member Bingaman also.
Quick question. On the losses, I can't remember which funds have the New Mexico portion in it. So those real losses, which funds did they hit?
The loss this quarter?
Yes.
Yeah, if you turn to, it's right after the page at the end of it, so go back one slide, I believe. Yeah, so this slide here, it summarizes the top gains and top losses by fund for you. And so you can see the top losses there. And four of those five actually had the co-investment realized loss that we reported this quarter.
Madam Chair. Member Bingaman.
Thanks, Madam Chair. Yeah, just to address the concern that the Treasurer raised, I think is a valid one about companies moving out of state. I mean, I think that's always a disappointment, but many of those companies do leave significant number of employees behind and help build our ecosystem, even if the headquarters moved out of state. We invested at my firm in a company in Albuquerque in 2011 that had about 20 people. That company was sold and their headquarters is now in Denver, but they now have 300 people, including 50 out in New Mexico. So they've more than doubled their New Mexico workforce, even as their headquarters, moved out of state. So I think that's important to keep in mind as well. Even those companies can help build our ecosystem.
It's a great point. It's something that other ecosystems have seen. Utah's a great example. The big kind of catalyst in the ecosystem is, you have to remind me, Richard, Adobe bought a large Omniture and then created a large branch office there, created some wealth of the employees in that company. Some of them stayed at Adobe, some of them went to startups. And so, the headquarters sometimes, I think, not always the best measure. It's the impactful employment in the community, and as long as that's grown.
And Member Bingaman, we will continue to track the jobs and the expenditures for those companies, even if they move out of New Mexico for the reporting.
Because on the other side, Madam Chair, you have a situation where they could fail when they get the money from New Mexico, and then they go to another state, and then they're successful because they learned from their failures the first time, and then they got more of a benefit from the investment than what we did. That's the other downfall that could potentially happen, and that was another reason why I was concerned. We put this fund specifically for New Mexico businesses to prosper, and it's an easier fund to get into, but then you decide to do it and then use the system to get in and then get out, and that hurts us too. And so I don't know if that's something that we can help navigate with requirements of if you're going to be here, you need to be here. Or on the other end, to Member Bingaman's point and Mr. Cassidy's, it could potentially also help us. So we don't want to,
Yeah, no, it's a great point. And one of the things we look at with each re-up is what is the New Mexico activity. So if we have a manager that's moving companies out of New Mexico, we're not going to re-up with them. So that's a big incentive for these managers as well. If they want to continue a relationship with the SIC, they need to be making progress towards New Mexico economic development.
And just to put a finer point on Member Allen's comments, I think I would encourage the staff and council members, to the extent that you have the knowledge, to think about ways that we can leverage that, world-class investment, those managers, those folks that have that knowledge to help, to the extent that we can, to help the businesses be more successful. Great point. I think we should pursue that.
In the past, when we've talked to some of the VC and private equity, where we placed investments, they've offered to come here and help mentor.
Okay, so that's going to become a standard question now for every commitment we have in front of us.
Yeah, and again, I think that's only fair. I think it's something to help our state. And, another issue, I know we're investing in funds, but how much in the funds that are theoretically for New Mexico funds, how many of those dollars are actually going into New Mexico businesses as opposed to somewhere else? I feel like we really need to look at this and look in a good way of how we can work with the universities or the labs and kind of coordinate educating these people, because I think we have a role. If we're investing in these companies, we want to help, as any VC does, help, fingers in, so to speak, in helping them be better business people and be able to know how to grow and continue their funding.
Well said.
do we have any type of partnership or connectivity with the economic development? What does that look like?
There's a number of programs in the state right now, and we do actively, about, our original statute really relates to tech transfer out of the labs is really the reason. Commercialization was, there's another couple programs in the state that have a slightly different purpose than ours, so we discussed with them, what our roles are and, good dialogue with both New Mexico Finance Authority and Economic Development through the phone.
Jason and Rita, is that what are you saying?
No, it's, New Mexico Finance Authority has a venture capital program, and then, Mexico Finance Authority and Economic Development are working on a program, SSBCI, small, alphabet soup. But, it's some federal money that, the state was appropriated, which, MFA is helping, EDD, allocate.
Madam Chair, under the terms of House Bill 104 and then supplemented by, I'm not sure what the number was this last session, that took it to $50 million for the program that the NMFA is managing. And then there's $22 million that Chris talked about that comes from the, SSBCI money. That fell under that was placed under the New Mexico Finance Authority, and they didn't have the requisite, I don't want to say skill set, but they needed some help with their process. And I've been made aware that Chris has been very, very helpful to them, has been reached out to and then included in a lot of the planning that they're doing. So it's been very helpful, and he's in a great position there to help them manage that program in a way that's positive for everybody. So I want to make sure that the council's aware that Chris has been doing that for them, and they've been very appreciative. They are very appreciative of the fact that he's doing that.
Anything more? Mr. Jennifer, speaking without Governor Ross here. All right, we're gonna finish up our PMRs with, real estate real return, agenda items 2G and H, and I'm just gonna let folks know online as well. As soon as this presentation is finished, we're going to recess for 15 minutes. We would like folks to have a little bit of a break before we move into our very packed voting agenda. So from whatever time this finishes, we'll add 15 minutes and we'll reconvene at that time. Table.
Thank you, Madam Chair. I'm joined today by a new face to everyone here, Malcolm Blake, Tom Townsend, and Rob Coaches as well. I'm going to dispense with my ordinary introductory comments and say a few words about co-investments and how they apply in my asset classes. I'd lead off by saying your asset class directors are intently focused on managing the cost to implement our strategies, and we're frequently engaged in conversations about how we can best use our advantageous scale and liquidity position to drive favorable economics for SIC. Co-investment opportunities are just one of several tools available to blend down fees that are accessible in the market because of our increased size and relevance to the general partner community. These co-investment opportunities generally fall into two categories. You could have bespoke structures more along the lines of separate accounts or commingled co-investments. The market term, and this is an important consideration, but the market for terms across co-investment strategies varies by asset class. And so we've heard a lot about no fee, no carry, and that's a prominent structure in the infrastructure asset class. When we're looking at real estate related funds, the starting point typically is a half fee, half carry structure. There are a number of other variables that go into the economics, and I won't get into what the details of those are currently, but just suffice it to say that we're engaged in conversations with our GPs about a number of different ways to adjust those structures to create an economic advantage for us. Smaller numbers like 10 basis points sound relatively small, but when you apply those to large commitment sizes, the bottom line impact can be very significant. So a 10 basis point haircut on a fee, for example, on a $100 million portfolio drops $100 million, rather $100,000 to the SIC bottom line year in, year out. So it's an important endeavor, I think, that we're engaged in. I would add these co-investment opportunities don't just happen. There's a significant amount of effort that goes into those. I'll just add some kudos to Evan, because every time we do one of these, he's looking at a second documents, and so his effort is much appreciated, but it's quite a burden when we do. Bottom line is, we're not going to pursue co-investment vehicles unless there's an economic advantage where we think we're going to
impact the economics to, the SIC. I'll stop there. If there are any questions, I'd be happy to handle those here, and if not, I'll hand off to Rob.
Just a point of clarification, Madam Chair. Have we been doing co-investments?
We've done a number of co-investments over time, and actually one of the ones today will be a top-up of a co-investment.
Okay, hi, everybody. I'm Rob Coaches with the Townsend Group. I don't have a name tag today. Sorry about that. Malcolm Blake's going to talk about real estate markets. Our fearless leader is online. He couldn't make it to the meeting live today, so we're here. And you've seen Malcolm before on Zoom calls, at least, but he's been with us for 5 years in Townsend and before the SIC in the past. Malcolm's going to cover real estate. You know, the real estate markets are still in the midst of a correction, broad-based market correction in valuations, basically, as a result of a historic rise in interest rates that occurred over the last 12 months or so. And you'll see that in the numbers for real estate today. I'll cover the real return portfolio, which is actually a little bit of a different story, and it's an interesting contrast between the two portfolios today. And we are, because these are mostly private market investments, we are looking back and covering performance through June 30. The numbers are, a little bit dated at this point in time, but there's a lag associated with the private market performance. So with that, I'll turn it over to Malcolm.
Great. Thank you all for your time. I'm going to start on performance on page 138. Performance has been good on a relative basis, and you're beating the benchmark on all shown periods. However, the quarter and 1 year periods are, on an absolute basis, negative. As Rob mentioned, there's a correction in the market going on. And then I'll skip to the next page as well, focus more on an income basis. Both portfolios, the 2005 and 2011 inception, have had consistent incomes, and that are holding up even as values correct today. Since inception, 45% of the portfolio's total return is generated through income, and that offers good downside protection, so the portfolio has also witnessed good appreciation during the same time periods. If I could skip a few pages to 142, I'll talk briefly about one significant event primarily. You've heard about this before. It's Jamestown. This fund is challenged mostly through its office exposure. And so there's liquidity is a challenge. Please note that there is a full redemption put in place. All of the other events on here are more standard, if you will. There's an acquisition of a firm and leadership transitions and succession planning. One more page on 143, this shows a public market equivalent analysis, comparing sort of a public market equivalent or hypothetical portfolio using public market investments is the dark blue chart, and the greenish blue shows the actual portfolio's return. Please note, the key takeaway here is that the portfolio is getting a healthy illiquidity premium for being invested in private markets, approximately 650 basis points for the 2011 inception portfolio. One more page, the update on two funds in the portfolio. Both are performing very well to the benchmark despite market corrections. These are driven by investment themes. The first is called the Carlisle Property Investors, and this is a diversified fund that's focused on the alternative sectors primarily. These are outside of the primary four food groups, if you will. This fund is focused primarily currently on single-family rental, medical office, and senior living, and this has helped drive the fund up from the benchmark by 90 basis points and 767 basis points over the quarter and 1 year periods. This performance continued in the third quarter, this time beating the benchmark by 210 basis points. The other fund I will mention is the Clarion Lyon Industrial Trust. This is a pure play industrial strategy and beat the benchmark by 190 basis points in the second quarter and over 1,200 basis points over the trailing 1 year. In the third quarter, it continued outperformance, beating the benchmark by 270 basis points. In conclusion, looking back over the year, the pacing called for $1 billion of commitments this year, and to date, 850 has been approved. I just want to applaud you all. It's been a busy year, but there's results to be shown for your efforts. And I'll pass it back to Rob.
On page 141, we're looking at 65% exposure to core investments, 35% exposure to non-core investments. You mentioned fees at the beginning and the cost savings. Is there any type of data or spreadsheet that shows us what those cost savings look like by being able to co-invest, or, what we've been looking at as far as the fee structure?
Then there's,
Yeah, we don't have a chart in this presentation that shows all the fee savings. The fee savings come in a variety of different formats, so you do get a lower fee on co-investment sleeves, that are invested, but there's also a number of different fee breaks for the size and scale of your investment to the fund, and, just straight out negotiation. Sometimes we also have the ability to, we negotiate with the managers to treat all of our clients, all the Townsend clients collectively as one investor, so you get the benefit of that scale as well. So there are a variety of different ways in which the fees are cut or reduced. Program. And we can put a sheet in our report that shows those fee savings over time.
I would appreciate that, because it's talked about verify is one of my philosophies. The other question I had is, we've outperformed the benchmark by quite a significant number. Is that consistently the case? Do we need to look at or review the benchmark? Are we looking at the correct benchmark for what we're doing today? What's your thought process on that?
that's a good question. The core benchmark for real estate is the Odyssey core benchmark, net of fees. I think we'll have some further conversations about what the appropriate benchmarks are when we do the structure. And there are certainly arguments to be made that the higher asset classes or component of that asset class, so the value add and opportunistic, perhaps should have a premium or something like that associated. Question.
Madam Chair, can you remind me when the last time was that we looked at the benchmark for this particular area?
Yeah, it was at least 5 years ago.
Oh, yeah, definitely.
What you have is the best benchmark that exists in the asset class. It's clearly the most prevalent in terms of institutional investors, larger state funds, et cetera. And in private markets, benchmarking is always a challenge. And I think with respect to your portfolio, which is still heavily weighted towards core-like investments, your benchmark is a core benchmark. And so it's appropriate for what you have. And I think the issue would be if you grow the non-core, the higher risk investments as a proportion of your portfolio, you might think about adding, a premium Odyssey plus 50 basis points or 100 basis points or something like that. And that's what a lot of our clients do, is they increase the risk profile of their program. They're still at over 65% core, so it's an appropriate benchmark for your risk profile.
Thank you very much for the presentation.
We have one more question.
Are you seeing any risks in the portfolio from Chinese money because of the collapse in the real estate market in China? I heard that the FDIC is hiring like 11 or 12 people just to do workouts for where there's been Chinese money behind in the real estate investments.
Yeah, no, that really has not been an issue. I think, you invest through managers and real estate operating companies that buy direct, and if anything, they're buying from investors that are backed by foreign capital. There may be some crowding out. There's more competition for deals, which drives pricing up when you have multiple capital sources chasing the same types of assets. But the U.S. is by far the biggest, richest, deepest market in the world. And we do have quite a bit of foreign direct investment from all kinds of foreign investors, Middle Eastern investors, Asian, European, et cetera, Canadian investors. So that's always a challenge, and we don't see that sliver from the Chinese as prevalent or growing and becoming problematic.
Yeah, the most significant risk, I think, across real estate currently is the rise in interest rates and the implications for refinancing. Valuations have come down, rates have gone up, and so if you think about the debt that an individual asset can carry, that has gone down, and so it leaves you with a hole in the capital structure. And so there's a need for people to commit either mezzanine types of security or new equity into the individual properties, and that's something that's kind of across
many market segments, office in particular, but a lot, and that's where I would characterize the biggest.
Okay. Yeah, we'll move to the real return, portfolio, which again is 12% of your total, program value, at least the target is 12%. That is over $5 billion today. I'm gonna start on page 178 in your materials. And, the real return program is targeting more than $5 billion in investment. You have about $3.3 billion invested as of, June 30, with a number of commitments above and beyond that, to try to build that up. We've talked about this at prior meetings, that we're in a little bit of a catch-up game with the, real return portfolio, because you've increased the allocation, plus you have a growing investment pool. So the pie is getting bigger, and the slice of the pie allocated to real return got bigger. And so you're playing a little bit of a catch-up game in terms of real return investing. On page 178, you can see that we'll talk about real return as being a collection of a variety of different asset classes, and the first big cut is between real assets and financial assets. The financial assets are only 20% of the real return portfolio. That's going to change around a little bit, I think, in connection with the efforts you're making to consolidate and build out your private credit portfolio. A lot of the financial assets that are in this real return portfolio are actually private credit type investments, and so there may be some moving around of investments into different buckets that'll again create more capacity for more of the real asset type investing in real return. The performance for the real return portfolio we show on page 179, and the story here has not changed. The trend is the same. This portfolio, unlike the real estate, which is adjusting negatively in value to the rise in interest rates, this portfolio is holding up pretty well. It's a very diversified group of investments. We'll peel the onion back in a minute and talk about that. But returns are positive here. In fact, the last year, primarily a boost from the energy component of real return. The numbers are over 11% net return as of June 30, which was well above your benchmark, over 500 basis. Over 500 basis points above your benchmark. And over the long run, your 9.6% annualized return out of this real return portfolio, again, 400 basis points over your benchmark. The 5 and the 10-year returns there was a dip when there was a large correction in the energy sector. So you see that volatility associated with energy impact the performance here. But over the long run and the near term, you've had very good performance out of this portfolio. I'm going to talk about the real assets piece, which is 80% of this real return, starting on page 181 of your materials. And you can see the various sectors that comprise real assets. It includes agriculture, commodities. There's an allocation to that. There are no commodities in the portfolio currently. Energy investments, infrastructure, timberland, and then there's some other miscellaneous investments thrown in. So this is a collection of a variety of different asset classes. But the key characteristics of all of them are they're backed by a hard asset, generally speaking, mostly private market investments, and generally you're speaking about a hard asset that has some sort of contractual income return. So income is a big component of this portfolio. On page 181, you can see in the middle of the page there, you committed about $708 million this year to real return, which is above the long-term average of your commitments, but that reflects the fact that we're trying to grow the portfolio and we're playing a little bit of catch-up in terms of the allocation growth in the portfolio. I'm going to skip to page 183, talk about the performance again of the real assets piece. Similar story, similar return profile as the overall return portfolio. Over the long run, significantly above your benchmark, as well as over the near term. The dip here in performance is on the 5-year number, which again is reflecting of the energy correction back in 2015, 2016 that impacted the numbers. I'm going to skip ahead to page 186 just to talk a little bit about diversification. Here again, you see the different sectors that make up the portfolio. As you can see in real assets, over 50% now of your market value is in various types of infrastructure. And again, the definitions all matter. Infrastructure is not a very well-defined term. It's a collection of a lot of different things. So that sector includes a lot of different things, some energy components, some transport, communication, there's some social infrastructure, and there's a variety of things that fit into that bucket. And deeper in our materials, we will start to break that out. You'll see it, I think it's on page 211. We're not going to turn there now, but we'll break that out in future reports to give you a better idea of what's included in that infrastructure portfolio, because it does really have a lot of different sectors that have different return profiles and attributes. And so we'll start to break that out a little bit more so you can see what's in that portfolio. And finally, the last slide I'll talk about in real return and real assets is on page 187. And the point here is just to show you that the vast majority of your real assets portfolio are in the U.S., but you do have a significant global component with exposure to other developed markets around the world and some exposure to the emerging Americas, primarily Brazil and Chile, where you have some investments in infrastructure and timber and agriculture. And that's the end of my report. If there are any questions, happy to field those now.
All right, Madam Treasurer.
A quick question. On that last page that you were talking about on page 186, you mentioned that you don't have an exposure to commodities. Is there a specific reason why? Is that,
We're
curious?
Yeah, so I guess there's two components of that. One is, upstream oil and gas is obviously a commodity-related exposure, and there is some upstream oil and gas in the portfolio. We have evaluated a range of metals and mining oriented investment strategies and have not found one that's been compelling at this point. A lot of the premier assets are held in large public companies, and one of the conversations we're having around a real asset structure study is whether it would make sense to have a sleeve of public company exposure to own some of those types of assets. And so it's an ongoing debate, but we've not found the right investments that populate the portfolio at this point.
And then one last question on this issue. The second bullet, infrastructure, you alluded to us going over the 50% threshold. Is the 50% part of the asset allocation, or is that, what's the 50% threshold? And I know we're going over it on purpose, but it's part of the asset allocation. Who made that decision to do that? Because on one end, of course, we want to comply with what the council agreed to, but on the other end, when you have opportunity, you want to take advantage of it. So I'm just curious from that perspective, if you could give me some guidance.
So it's actually over on the infrastructure side, and this is one of the things that needs to be addressed in the structure study, right? If you look at the financial assets bucket, there's about half of that is MLPs, and they're not rolled up in our current reporting into the energy-related exposures. And so if you simply move that 8% down into energy in a more holistic way, each of the buckets would be within it.
Okay, so then that alludes to my next question. So you basically are able to manipulate the numbers on that end because of what's in it. But is it something that the council needs to reevaluate based on the current environment to increase infrastructure as part of the asset allocation?
I think that's part of the structure study that's done annually on this portfolio. You have these kind of internal allocations of these various sectors that make up real assets and real return. And we would encourage you to think about those targets as where you want to be 5 years from now when this program is built out and funded and invested. And I think you're going to be overcommitted to different sectors because you're shooting for a target that's much larger as the program grows, 5 or more years out. And so to some extent, the 50% is really a target. And I think over time you can build towards that and rebalance the portfolio to where you want to be once it's fully invested and fully funded.
At the higher level, we're looking at a breakout that would have essentially 80%, and that'll be something that'll have to come back here for a final approval. But something on the order of 80% in infrastructure, and then looking at
highways, MLTs, pipeline infrastructure, could be another piece of that. And so, I would just caution against, construction as being a narrowly defined sector. There are many, all quite different.
I would just say, remind us, because an 80% infrastructure sounds like we're not diversified enough unless we define within that policy that infrastructure includes all of those aspects of it. I think the last time we looked at this was this year, correct, that we had approved it, or has it been a while longer?
That's actually been a while.
A while.
So when is that structure study set to come before the council?
I don't think we have a date at this point, but I think we need to do it over the course of the next 12 months, certainly.
I would encourage, and I meant to actually say this when Chris was giving his presentation. So have your staff looked at the, Goldman Sachs Carbonomics from March of this year? Oh my gosh, you need to dig into that. It talks about all of the investment that Goldman Sachs is projecting is going to come into renewable and green projects over, they project out to the 2030. And they are above and beyond what the, GAO or whatever, whoever did the analysis on the, IRA projected, they're over and above by factors.
Bloomberg has,
I think we need to look at where, you said where we want to be in 5-10 years. I think green and renewable projects in infrastructure, in energy need to be a part of that. And the way that you break out infrastructure, can we break out energy as well? In that same way, to say like what is oil and gas, what's traditional fossil fuels, and
that's part of the problem, because the infrastructure slice of the pie here includes a lot of renewable strategies. Now, is that infrastructure or is that energy? So there's some definitional problems that probably should be worked out and crystallized as you go through this, review of the portfolio and the structure study portfolio.
I think my last comment to all of that is that if we're putting one of our hands behind our back because we're not providing you the percentage increase for you to take on the opportunities that the current market is allowing you to take on, and the amount of good work that's being done to keep the benchmark higher than keeping the return higher than what the benchmark is, then we need to reevaluate that more sooner than later, just to give you that opportunity, because it sounds like on the commodities aspect, that percentage is not going to be a mark that we're going to hit right now just because of where we're at in our environment. So if that's something we need to look at sooner, we should probably do that just so that we can make sure we're not stopping ourselves from being able to invest where we actually can with the amount of money that we have. Thank you, Madam Chair.
further questions from council?
Good feedback, thank you.
Thank you. All right, so it is 11 o'clock. We will reconvene at 11:15. everyone is, refreshed from that break, you've got to walk around a little bit, use facilities. We will now turn it over to, Chair Lavender for his investment committee report, agenda item 3A.
Thank you, Madam Chair. We had, as you can tell from the agenda, today's agenda, we had quite a meeting, a little 3.5-hour meeting basically on, at the investment committee. I think this is gonna be pretty, we've mentioned this before, I think this is gonna be pretty common and pretty normal. But this is the kind of agenda we're gonna have, at least while we have these incredible inflows keep coming into us. Rather than belabor the fact, what I'd like to do is, turn this over to Vince. Let Vince take us through the agenda. And, we've got a number of voting items. I'll ask the, Madam Treasurer and, Kathy to, share the, motion making with me if we can.
Yeah.
Is that okay? And each of these investments, after thorough review, were approved for submittal to the council on a recommendation of approval. Well, Madam Chair, just a couple of very quick comments. As everyone said, the obvious heavy agenda here. We've got 2 strategy items up front. First, we're going to review the investment policy. Hopefully that'll take just a couple of minutes. We bring that before you periodically, to tune up a section or 2. This just adds the new funds and some new asset allocation numbers in it. You've had a chance to take a look at it. Marcia will take us through that. And then we really wanted to get in front of you an update for the pacing and inflows. That's really the basis, as Chair Lavender pointed out, for a lot of the activity that you're seeing month to month. So Donna Iglesias and Nina Carpenito update you on both pacing and inflows, and then a full slate of do it.
Okay, without further ado.
Let's start with Marcia.
Certainly, I'm hoping you've all had a chance to read it. I'm happy to go through all the changes, or you want me, okay.
Yeah.
All right, so, changes begin on, diligent 222. And here, we're adding the funds. We're adding early childhood, and we're adding the 2 new funds, Conservation Legacy Permanent Fund and the Opioid Settlement Restricted Fund. So that's mentioned on page 222, and then on 223 and 224, there are descriptions of each of the funds provided by staff. It explains them why they're there, and that you have been given authority to invest those. Next change is on page 227, and it's just clarifying to the point I think the treasurer made, and maybe Madam Chair, on asset class structure reviews. Those are done at least every 3 years, and we clarified that in this policy, and also made a change, Vince and staff annual reviewing them annually. The next change begins on 230, and this is all the work that you did earlier in the year on asset allocation changes. It looks very complicated. Once approved, we'll get rid of all the red lines. But we have noted the allocation changes in the addition of those 3 new funds. Also to fixed income, to Tom's earlier comment about the structured study for fixed income, you'll note that we put in policy that it's not core fixed income anymore, it's public fixed income, and non-core is private market fixed income. So that's reflected in this policy as well. That's on 230.
Ms. Fraser, just real quick, on that one, is that since what we did when I first came on board? That was the change on the okay.
That was the structure study for fixed income, right?
Thank you.
Page 231 through 234 is taking those asset allocations by each of the funds and putting in the target and the minimum range and the top of the range. So the allocation change required a lower limit and an upper limit, so those were all changed, and that's reflected on those pages for all the funds that had allocation changes, plus the 3 new funds. And that the range, that's the range in which you give staff, they can work within that range to rebalance.
And Madam Chair, Vince, those are the same percentages that we had already approved. We're just putting them in the policy because we hadn't updated the policy on that.
Correct.
Correct.
Nothing, okay, thank you.
And then on page 234, there's some clarifying language that we talked about earlier today about the interim targets because of cash flows that you can't get to your target allocation. So, this is clarifying the language that staff can set interim target allocations and report those to you. The next change, is on 239, and this is in, taking those allocation changes again for all the funds, plus the 3 new ones, and, setting those benchmarks for each of the asset classes. And in particular, because of the fixed income, asset class review, that benchmark actually changed. It was discussed earlier today for private fixed income, private markets fixed income. It's the credit risk leverage loan plus 2. That's in policy. And then private equity had made a change in reporting, and it was being done, but we're reflected in policy where you have 2 benchmarks for Cambridge, and then the secondary, the global equity markets plus 2. And on page 241, again reflecting the naming change in fixed income from core fixed income to public, and then on 242, changing from non-core to private markets. And lastly, the discussion of a couple of years ago on ESG, that is on page 55. That was approved, so we put that in the policy, and that begins on 255.
Madam Chair? Okay. Let's go back and, I'm gonna go to 250 after, but let's go to page 234. Sorry, I have to get back there. Okay. So with the understanding that deploying capital takes time, especially in private markets, the CIO and investment staff may set interim target allocations until the strategic target allocation is achieved. So you're asking us to give our authority of the asset allocation to the CIO. And how would we know when that takes place, or for how long that would take place?
He reports when the staff reports, the interim targets to you, if he wants to set the interim targets, and then each quarter, each monthly report is reported, because it's an interim target. And compared to the long-term target.
Can you help give me some guidance on that, because that makes me feel very uncomfortable.
Sure, yeah. So the council's always approached the oversight, of what happens in the office, from a pretty close perspective. So you look at all the investments, you ask them to approve asset allocation and things like that. But at the same time that they've done that, this is just a historic perspective, at the same time they've done that, they've given us as much implementation, room as we possibly can. So this is just part of that implementation that after you approve that asset allocation, if we've made changes that it's gonna take us a couple of years or something to get to, we always talk about that when we're doing the asset allocation. But, as we implement, and it's a lot through the pacing and things that you all see, we may need interim targets, and in fact, we do have interim targets on this last asset allocation. So really, this language is really just a function of what the council's always done, to give us as much implementation room as possible. So rebalancing and interim targets and things like that.
So instead of doing that, Madam Chair, why don't we just come to the council with that determination of what that asset allocation needs to be at that moment until later? The reason why I'm bringing this up is because we keep saying, and everyone at this table says, that the main course of what the council is supposed to do is the benchmarks, the asset allocation, and the investment policy. and yet we're flying through this investment policy, and we're giving our authority on the asset allocation, which are the three main cores of our job. So, what is your thoughts on that?
I would say in your oversight function, the closer that you get to implementation, the less, who's left to oversee, right? So if the council's gonna make every decision on, approve these investments with right of refusal when we bring them, the council's gonna determine what the asset allocation will be, if the council's gonna determine what the interim targets will be, if the council's gonna determine rebalancing, all those things, who's left to oversee? So I think that's one of the reasons historically the council's given as much running room on implementation as they can. Approvals of things that they.
And Chair, sorry.
Madam Chair, I would just point out that we do bring back those interim targets to the council for approval through voting. And so you are updated on those. We do bring those.
Well,
in the past we have.
I would just say, as a devil's advocate, what's the point of us putting in an asset allocation if it can always be changed by staff?
This is clarifying what the practice has been. The practice has been that the CIO writes a memo and reports that these are the interim targets, and then they're reported on a quarterly basis, and the report, or actually monthly basis. So this is clarifying that the practice. I don't think it was a voting item, but it was a reporting item to the. Do you have recommendations around?
I would remove it. That would be my recommendation.
But what about recommendations around time to get there? So if we changed an allocation percentage, it's gonna take time to get to that percentage. How do we invest in the meantime? How do we, while we're working, like, do you want a specific time to get to the target allocation?
Well, you always do. So let's say we changed this last year, we changed the target allocation for private equity from 20% to 25%. It's not expected that the team is supposed to literally get to that 5%. Yeah, but you don't need to have a new asset allocation for that. You're getting to 25. They're just working towards that goal until that level. We don't need to actually change the percentage of the target allocation during that time, because we already put as a council that we want to get to 25%. The team needs to have we have to have the patience for the team to find the right positioning to get to that 25%.
So I would argue that putting in interim targets gives the council more oversight, because if we just leave it wide open, like, you can get to the 25, and as long as it takes you a decade, that gives me more pause. That's what I'm talking about, time period.
I think also, Madam Chair, Madam Treasurer, excuse me, if you read that entire paragraph, it talks about the fact that the state investment officer has the responsibility for doing this, and I think all this does is really clarify how we get there. And this is an example of a situation where we need to give the staff, in my opinion, the amount of freedom that we can give them to make these interim decisions. And I think, to me, that's what's really important. So this is simply clarifying what happens in real life.
Well, and maybe there's something about.
Excuse me.
I mean, your point is taken. What's the point of target allocations if we're just gonna have,
And to your point, this still is open-ended. It says until it's achieved, so it could still be 5, 10, 15 years. So that doesn't change the fact that it takes time. I mean, I think when we target and we change the asset allocation, even the benchmark, it's always logically gonna take time to get there. It's not gonna happen overnight, because you have to do the research to be able to get to that point. So it's not like we would hold staff accountable for not hitting 25% in the first year. It's that that's the goal, and that's how much more room they have to be able to put into that asset class. I'm always very concerned about any changes on investment policies, benchmarks, asset allocation, and in particular, like the constitutional authorities or the delegated authorities by statute between whatever the board, council, commission has and what staff has. So that's the only reason why I am bringing it up. And I look at it based on not Vince, the CIO, just in person, a CIO and what that looks like. And worst case scenarios, because I worked as an analyst for so many years at the legislature, it's always putting it into perspective of worst case, best case scenario. That would override anything that the council provides as the asset allocation for any fund, just based on how it's written.
Madam Chair, I would just add in, the main reason of suggesting that the council have the staff, or allow the staff, flexibility and running room is based in that constitutional division of, and our legal teams provided, a lot of that stuff to you all, so I know you've read it. But the council is primarily responsible for oversight, the office is primarily responsible for a lot of the investment. So the more running room you can give us on implementation, the more in line we are with,
So I guess if, the council decides or votes on the asset allocation percentages and the staff determines how quickly get there?
that's a lot of the work we do in terms of the pacing model that you'll see here right after this report, the ability of our asset class directors to find investments. A lot of those things are done in the office on a daily basis.
I would say you could say with the understanding that deploying capital takes time, especially in private markets, the asset allocation or the strategic target allocation is achieved with timing that is based off of, and then what you just said.
The hole that leaves us, if we make material changes in the asset allocation, that asset allocation, new asset allocation then becomes our benchmark portfolio at the fund level. So as the treasurer pointed out, in one fund, we went from like 15% to 25% private equity. And knowing we can't get there in any time frame, leave ourselves a big tracking error of the actual portfolio to the new benchmark, the new asset allocation. So it makes sense to have interim targets in between so that it reduces that tracking error of the actual to the interim or the final. So we do need those from a performance reporting perspective.
So let's just put it in real terms. We changed it from 15% to 25%. You have the benchmark at the same amount. When you're presenting to us on a monthly or quarterly basis, how are we determining or knowing that the target is changed and not based off of what we had just done?
Those are all reported in your reports every month. So in Marcia's flashes and then the.
And the interim has come before the council, reported before it's implemented. So you have an advanced look at what that interim is going to be. I noticed in our executive summary that, we're starting the interim now, but we're gonna add another column, so right in front of you every quarter, or every month, you're gonna see what the interim is, and you're gonna see the long-term target. Plus, remember in your asset allocation, Chair and Treasurer, that, to review asset that has to review asset allocation with you every 3 years, but in fact, we look at it every year. So it's not a full study, but it's kind of a gut check study on an annual basis. So it's in front of you, actually it's in front of you every month. And I'm more inclined to memorialize that than I am.
Yeah, that's a concern. I'll move on to something else. On page 250, we didn't mention the strikeout of EAFE. I'm not familiar.
Yeah, I think that was, that in the glossary, Madam Chair. Yeah, that was, there's no other benchmark in the glossary, so it was, I mean, we could put all the benchmarks in there, but that was the simple reason why that was taken out, and I'm sorry I didn't mention. Is this rewrite, do you do this rewrite? We start drafting the rewrite, but it's reviewed by your staff.
And then as far as on the ESG, it's all redlined, what are the differences, or?
No, it's brand new, brand spanking new.
Incorporated.
We adopted it 2 years ago, and we're just getting around to memorializing it in the investment policy. Thought it should probably be part of the investment policy.
Absolutely.
Absolutely.
It's the same wording that you had on the other ESG one? Oh, okay,
Yeah, it's just simply a cut and paste, but.
got it. Thank you.
So I was wondering, on this, hold on with your motion. How frequently we look at, asset allocation. If we could add a line that says, so it says that every 3 years, we vote on it, or every 3 years we look at it. If we could just add something that says, it will be reviewed every year. If we're doing that in practice, why not put it in there? And we will, happy to do that.
Okay. And I would just ask if we can have two different motions, one for everything else and then one for this specifically, because I support the rest of the policy, but I do have concerns about the practice versus what we're actually writing in here as a policy. Or I could just vote no and then still pass. Okay.
So could we make an amendment?
I don't think there's a motion yet, but if you would like to have specific language as part of your motion that goes in, what you said into the policy, that you can do it every 3 years.
Would you add that to your motion to amend it to add that we're going to review the asset allocation yearly? Because that's something that we do, but I guess
Madam Chair,
not review.
on page 227, the table, the very top line, already has that in there.
Okay.
And Madam Chair, is there somewhere in the policy that it says that we review the investment policy every 2 years or 3 years?
Yes, that's line 3 in that same table. 227.
No, but that says for 3 years. And Marcia just said that even though this says 3 years, in practice, we look at it every year. Put that in here as that practice. Not to vote on it.
So that would require us to do a full asset allocation review of all the funds every year. I think maybe
So
what
then what are
Marcia's,
you referring to?
so I think what she's referred to is when they do their new capital market assumptions, they deliver those to us in March, and we run all of our current asset allocations through those new assumptions. So effectively, you're getting to see what your current asset allocations, how they're being affected by the new capital market assumptions.
I feel like it needs to be memorialized in some way, even if you don't like the language I use, whatever language you use. You can't use the one I use, I call it this. Something similar, a synonym, pull out your thesaurus.
Most funds,
What's wrong with
yep.
you?
Oh, nothing.
Glance.
Yeah. Yeah, we can figure out how to document that, Marcia.
But no, say something in practice that after capital markets or something, we'll figure out something.
There's nothing in here that affects our day-to-day. Madam Chair, we can bring it back to you next month. That if you want.
All right, let's do that.
And Madam Chair,
I would also point out that statutorily, a couple of years ago, we just changed it on 61010 that the investment policy has to be done every 2 or 3 years. I can't remember which one it was. I know you're not under that, but it might be a good common practice to do. The reason why we picked those years is because a lot of county commissions, councils, elected officials, they're out every 2 years, so at least it's coming before the board so that they can review what that policy and the requirements are. That might be a good idea or practice for us as well, because people are appointed usually every.
Number 10.
yeah, and so since we're just talking about it, I was wondering, do we have something in the policy that talks about when we revisit benchmarking? And is that necessary to have in our investment policy? Because I think I heard earlier that in one of the earlier presentations, we hadn't reviewed a benchmark in 5 years. And so I was just thinking at the time that is that appropriate, or do we need to be thinking about doing that more timely? And is that something that we would want to have in the investment policy? It seems to me that we would, but
If we don't list out are,
So,
how frequently we would run the
yeah,
asset class.
so that Chair, the line number 2 in that same table is the asset class structure reviews. That's inclusive of benchmark.
Do you see that, number 10?
Okay, yes, I see it in there. I just didn't know, yeah. I didn't know it was specifically referring to benchmark.
Not looking at the Odyssey since 2018.
We're a little behind on that one, yeah. We just had asset class turnover in that asset class.
Okay.
In fact, we did a comprehensive benchmarking review, I think, in the beginning of, but the Odyssey and Stern were subject to forthcoming structure studies. They were reviewed, but no changes were made.
They were reviewed and said that there was going to be an asset class structure pending on that, but they were reviewed.
Yeah. The thing we're behind on is this asset class.
Okay, thank you.
Practice that we're memorializing, other things in practice that we are reluctant to memorialize. Where's the dividing line? Member Tiff?
No, thank you for that. I just, it's just a lot to think about in terms of what we need to, revisit in this investment policy. And I just wanted to make sure we have a comprehensive kind of look at what we should have all in this policy. So thank you for that. It makes sense. Yeah. Thank you.
You look at this in the investment committee?
We didn't find any problems or issues with it, so that was at the investment committee level. We looked at what was in there, and because this is memorializing something we've been doing, it was approved several years ago, and it's something that we do, and it also goes to the flexibility and freedom of the staff to make the right kinds of decisions in the 29 days a month that we're not together. That's what this was approved, recommended approval.
Right, so we're going to postpone this vote for today.
Yeah, I'm sorry.
We're postponing this vote for today.
Okay.
Because we are going to add the additional language around when we see the asset allocation during the capital market.
And I just want to make sure that we're not, that our postponing it a month isn't going to impede anything or make any difficulty for anybody. Okay. Well, okay.
All right. With that, you're going to hear from Ms. Iglesias and Mr. Carbonino, and 3C, pacing and inflows update.
Just so you know, Madam Chair, this was, at the investment committee level, this is a terrific presentation, so everybody hopefully will have an opportunity.
Well, I'm hoping actually that it sheds light maybe on the previous discussion.
All right, good morning, Council. I'm Dawn Iglesias. We are going to be on page 257 of your diligent book. This is just a short overview for a pacing and inflow update on where we think we're going to end the year in terms of contributions into our permanent funds, and then also our commitments to our private assets. And then we also have some additional scenario analysis that we've been working on from our strategy group that we're also bringing to you. So turning to page 258, you've seen this slide before. I'm not going to go into a lot of detail on it, but this is how each of our endowment funds get oil and gas revenues. So for the majority of our funds, in terms of recurring revenues contributed into the fund, oil and gas is going to be the biggest source of that for the land grant, severance, tax stabilization reserve, and early childhood education and care fund. Other sources for other funds tend to be legislative appropriations, but these are recurring sources, and this is how these oil and gas dollars flow into the funds. So when we come to you with these projections, we're looking at specifically what are prices and production projections going forward, what are some scenarios around those, and then what kinds of tax and royalty revenue is generated, and then how does the statute determine those revenues come into our funds. We have a much better picture of exactly how we're getting funding into each of our sources. So this is just an overview of each of those. But in the interest of time, I'm going to skip forward to the next page, page 259. So for calendar year 2023, we think we are going to have another $8 billion year for the total calendar year. We have received over $5 billion so far through the end of the year. That includes $2 billion from the land grant fund, $945 million on the severance tax fund, if you look on this bottom right-hand table with me, $2 billion into the early childhood, and roughly a little over $200 million. There was another contribution from the opioid settlement restricted fund. So we're now sitting at over 5.2. But we do think that there's going to be significant funding coming in the last couple of months, particularly at the very end of December, when we should have a transfer into the severance tax permanent fund of $116 million that is required via statute from Senate Bill 378, and then a prior that is $92 million, and then a prior Senate bill that does $24 million. And then, in addition to that, we think there's going to be some leftover funding in the bonding fund at the end of the year, and that's going to transfer into the severance tax fund as well. There's going to be roughly $1 billion that's going to come into the early childhood fund on sometime in December after the audit. That's going to be from the oil and gas school tax. So everything the early childhood fund has received so far this year, that $2 billion number, that was from federal mineral leasing. We're still waiting on a school tax amount that comes after the audit is completed. And then the big amount that we did not really anticipate, and is a surprise to us, is the tax stabilization reserve, roughly $960 million per the consensus revenue estimate that came out in August. We're hoping that the new consensus estimate that comes out in December will have a better picture around what that number will be. That is not oil and gas money. That is unspent appropriations or reversions that would go into the operating reserve, but the operating reserve is already at its cap. So the consensus group is projecting that any leftover amount from that operating reserve based on the statutory cap will flow into the tax stabilization reserve, and right now they have that pegged at $960. Then we just also received $77 million in the opioid settlement restricted fund, and so that brings us at a little over $3 billion for what we're, or a little close to $3 billion in what we're expecting to get through the end of the year. So whereas last year, or earlier this year, we said we didn't think that 2022 would necessarily happen again as an $8 billion year, it does look like it's going to. If you look at the chart on the top left-hand side, or excuse me, top right-hand side, the lined bars are where we thought we would be in the annual investment plan in terms of our revenue estimates for each of these funds for contributions in. The black bars represent where we actually think we'll end up, given that there's only 2 months left. And then the blue bars, just for reference, show what those figures were in calendar year 22, so you can get a comparison to last year. So the biggest difference, again, is going to be that tax stabilization reserve amount. Now, the chart on the left is going to show our updated long-term forecast through 2050. So this is for each of our funds and where we think we're going to be in terms of inflows into those funds based on expectations for production and prices, and I'll show you those in a moment. We do think that inflows are going to continue to be substantial, especially considered to the past, or relevant to the past. So if you look at the 2002 through 2022, what that historical inflow is on this chart, you'll see that our estimated inflows moving forward are really significantly higher, and that's going to drive a lot of the things that you've been seeing both in the performance reports lately and that you're seeing in the investment reports coming forward. So there's a few really key things to point out about this outlook. The first one is that we do think that inflows will exceed our distributions for several years, so we'll have more contributions coming in overall than we have to distribute to beneficiaries based on their statutory rules. That gives us that significant opportunity to compound our earnings that drove a lot of your strategic asset allocation changes that you all made in April to, say, reduce fixed income because we don't need the additional liquidity, and to increase private asset allocations in order to deploy that cash and earn a higher return. The next thing is that with these types of inflows, we are still looking at having a lot of cash on hand that does need to be deployed, and that's going to be the biggest driver to the changes in our pacing expectations that Nino is going to go over here in a few minutes. But the overall arching theme is that you're going to be seeing more investments because we have more cash that needs to be deployed to meet your strategic asset allocations in your private assets. And you're going to be seeing bigger bite sizes, so larger commitment sizes in order to get this cash allocated. And the fourth thing that this means is that we actually have, as a fund, a lot of liquidity at a time when other funds are struggling to have liquidity. That puts us at an advantage when negotiating terms with our managers and trying to get access to funds that we maybe haven't had access before. And I'm sure you'll hear several discussions from our asset class directors on the advantage that our liquidity is providing us. So then, turning the page to page 260, these are our revised price and production assumptions moving forward. You can see our oil price assumptions haven't changed very much. They're a little higher in the near term, but in the long term, we're still using roughly a $60 average expectation in WTI, and I'll go into some more detail on that in a moment. Natural gas price expectations have not changed very much, but you will notice in terms of total New Mexico oil production. So these charts are from Rystad Energy in their long-term projections for New Mexico production for oil. And you'll notice that forecast that they come out with has come down since when we last did our annual investment plan in April. And you'll also notice that they're anticipating potentially a sooner peak in that baseline assumption for production, but still relatively high compared to historical levels, and a long runway in that decline that doesn't drop off very sharply, but instead peaks and then sort of levels a decline moving forward from that anticipated turnover. Natural gas production is expected to produce at higher for longer, as it's generally seen as a transition fuel, and that's consistent with Rystad Energy's estimates here. These estimates are based on things like well productivity and their updates to their long-term global demand outlooks for oil and gas. And to give a little more context on that, since these long-term projections, they're just that, they're forecasts, and while they're based in a lot of known data on well productivity, acreage, operator profiles, and their plans, the future is uncertain. We don't know what's going to happen the next day in energy markets. And because of that, we take this as our base case because we need to start somewhere, but we do also look at scenarios around that base case, and that's what we see on page 261. You've seen these scenarios before. We're using the same scenarios from Rystad Energy, and just to give you a sense of what these scenarios are, the mean is very similar to their baseline expectations, and that baseline is centered around certain milestones for achieving an energy transition, what that would do to the oil demand outlook, then making an assumption on what that would then do to prices and therefore production levels. So for example, in that mean scenario, assuming that EV adoption occurs according to manufacturers' targets but grows exponentially, that there's increases in plastic recycling and bans to reduce plastic demand, growth in sustainable aviation fuel. These are the types of assumptions that go into that baseline oil demand outlook. So as you can see, a transition is already baked into that baseline. And then your plus sigma and your minus sigma is a difference in timing and certain targets being met within that transition profile. So for example, the plus sigma is more of a slower transition. It takes longer to be implemented, so things like EV adoption happens more slowly. Plastic recycling rates increase, but not at the same level as the baseline, et cetera. In the minus sigma, that one is more of a faster energy transition, greater adoption of EV. It also has to assume things like all EV consumer constraints are resolved, and then therefore that can increase EV production and adoption, greater plastic recycling, greater oil substitution. Those types of things are baked into this baseline for a faster transition scenario. So then we say, looking at these scenarios, how would these different potential future outcomes affect our inflows into each of our funds? And then based on those changes in inflows, how would that change our pacing as we're making these commitments to private assets? And that's what we look at on page 262. Or starting to look at that. This I want to show is a way of thinking about those different transition scenarios on a sort of probability basis. Rystad doesn't assign actual probabilities to either of their scenarios, but if you look at them in terms of where they sit versus price curve. So the blue dotted line, the blue line with the yellow dot, that is going to be their base case assumption for New Mexico oil production. The yellow solid line, the purple solid line, that's the slower energy transition. The red solid line is the faster energy transition. And the dotted lines help to visualize where these transition scenarios fall relative to scenarios that say, if we weren't considering the transition, if we were just looking at the acreage available, the well productivity, and if nothing else mattered other than the price of oil, where would those production profiles fit? And then you can see them plotted along with those energy transition scenarios. And there's a few key observations that you can glean from this chart. And the first one is that across all of the scenarios, regardless of price or the energy transition scenario that's in there, that New Mexico production is expected to peak by the early 2030s and potentially sooner, depending on those scenarios. The second thing to notice is that when you look at the distribution of these scenarios, if prices are above $60 a barrel, then it's more likely to have production that is exceeding the base case as opposed to production that is below the base case. So as long as prices remain above $60, given the economics of production in New Mexico, we might actually be on the more conservative end on our estimates in our base case, which is good in terms of trying to allocate to our private asset classes. We would prefer to be a little more conservative than a little more aggressive, because we can always do more. It's very hard to do less. And then just very quickly on page 263, this is how those different scenarios, the price assumptions and the production assumptions, if we flow those through to the inflow estimates specifically for land grant, severance tax, and early childhood, how does that change for each of these cases? So you see the black dotted line, or the dark blue dotted line, this is our base case. And it represents what our pacing models are based off of when we bring our commitments for our different asset classes. We're going off of those numbers, but we are looking at where those ranges fall. So, for example, the light blue line, solid blue line, the Rystad U-Cube, that's their base case. So it says if we use nothing other than Rystad data, their base case and their prices, which we don't do for ours because we also use Oxford Economics and EIA. We use more than just Rystad as a data source. But if we were to use nothing other than Rystad, that would be that solid light blue line. And then those plus and minus sigma scenarios you can see in the dotted lines that are above and below. The one thing that I'll note, you can't see the history on this chart in trying to show for size here, but one thing that I'll note in that minus sigma scenario, even when you start to get down to those lower numbers, that is still significantly above our historical long-term averages of inflows across our funds. The average from 2002 to 2018, prior to the oil production boom in the state, was $460 million. So prior to 2018, what we could consistently see on average was somewhere plus or minus $450, $460 million. So in this minus sigma faster transition scenario, it would still have more inflows into or across our funds than our historical average. And that's because we had such a big ramp up in production, and even if that production were to come down more quickly, it would still result in more revenue than our historical long-term averages for quite some time. The chart on the right then takes these inflow estimates and says, if we use RBK's capital market assumptions, we look at our asset allocation studies and grow our funds based on those capital market assumptions and these different inflow outlooks, how would our long-term growth change? So, for example, these blue bars, this is our base case, and you can see here that in 10 years we are still expecting to be roughly $100 billion based on those, our baseline inflow estimates and our standard capital market assumptions. The U-Cube is just slightly lower, so as you can see, even though the U-Cube estimates, if we use nothing other than RISAD for inflows, it would still put us close to that 100 billion, but not quite over that 10-year time frame. And then the plus sigma and minus sigma transition scenarios, those range anywhere from an $80 billion to 120 to $130 billion by the end of 10 years. So still significant growth that is very largely inflow driven, even under the energy transition scenario. And with that, we then take these scenarios and say, okay, looking at these different outlooks for the future, how would our pacing change based on that? And so I'm going to turn it over to Nino.
So these inflows are the reason for our increased level of commitment the last couple of years and at least the next several years. As such, we decided to take our scenario analysis one step further and apply the results to our pacing model. The result was the range of future commitments that are shown on pages 264 and 265. So on 264, we have our private asset class commitments. This is shown in aggregate. Let me explain the chart just a bit here. So a solid line represents an actual amount, while a dashed line represents an estimated amount. Prior years are shown by vintage year, which is defined as the year in which a fund begins investing. Current year is a combination of prior year and current year commitments that began investing during the year, prior and current year commitments that have yet to begin investing. Future years are shown by commitment year. The current year tends to be overstated but will flatten at year end, as prior year and current year commitments that have yet to begin investing are rolled forward to the next year. However, this particular current year is more pronounced for two reasons, which I'll discuss shortly. The red and blue lines represent the RISAD plus sigma and minus sigma scenarios, while the yellow and green lines represent our internal RISAD UQ base case scenarios. As Don mentioned, the yellow line is used in our pacing model. While the yellow line may appear to be a simple average of the red and blue lines, we know from our analysis that the red line is far more likely to occur than the blue line. So much so, we would argue that the true bottom of the range is the green line, suggesting conservatism on our part.
I'm trying to think of the best way to say this. So again, the transition is still baked in regardless, but it does seem, based on the types of assumptions that each of these transition scenarios has to make, and then those price curves, right? So anything $60 and above would produce more than what we assume in our base case. So in order to have fewer revenues in those transition scenarios, to get closer to that faster transition scenario, you would have to have a significant drop-off in price. And so significant that it would have to drop to $30 or $40 a barrel and roughly stay there. Now, in that UQ, or in that minus sigma scenario, you'll notice if you turn to the previous page, that's exactly what they assume. They assume prices drop off because there isn't demand, because the transition has happened sooner. So, but as long as prices are above that $60, meaning that there is demand there, then it is more likely that we would end up with a slower transition than a faster one, noted compared to our base case. Now, our base case still assumes a transition occurs, and so I just wanted to make that clarification.
Thank you, Doc. So on the next page, we show the private asset class commitment, but we show them separately for each asset class. I'd like to take your attention to the upper left chart, which shows the private debt portfolio. Note the decreasing level of commitment and the reasoning for that. So the strategy for the current year and the next couple of years is to focus on open-ended funds. Open-ended funds tend to draw down the entire commitment within the first year, helping to absorb our excess cash, and offer recycling options, reducing the need for pacing going forward. Vintage year risk is less of a concern because of these recycling funding options. This is the first reason this particular current year is more pronounced. The charts for the other private asset classes display the increasing level of commitment one would expect. Under all scenarios, the private asset classes achieve their target allocations in the desired accelerated time frame of 5 years. At that time, a decision will need to be made to either maintain the current target allocations or to increase them further. The next page is a review of commitments that have been made this year, and they're shown here for each asset class, and then a table showing the actual amount at the bottom. So during this year, we've made a total of 46 commitments, totaling just under $5.6 billion. We projected our commitments would be just under $6.4 billion when we did our annual investment plan earlier this year. The difference is a shortfall of $800 million. However, an adjustment is needed. And that adjustment is needed for the private debt open-ended fund commitment. Pacing models are designed for closed-end funds where capital is drawn down and returned over time. As a result, the net asset value will rarely, if ever, equal the commitment, so an overcommitment strategy is employed. This is calendar year. What the adjustment does is it reverses the overcommitment ratio for the open-ended fund commitment. With that adjustment, you can see that our pacing was approximately $800 million over what we projected. However, and I'll get into this in just a moment, many of these commitments, we went into them knowing that they would not begin investing capital until next. And
even though we made a commitment now,
correct.
you actually wouldn't.
Correct.
Correct.
Correct. And this is it's you know, as we've discussed and as you've heard from others, this is a difficult fundraising environment, and I would imagine that managers are offering more incentives for early investors, whether it be reduced fees or increased capacity, things like that. Because of our liquidity situation, we are taking full advantage of that. So yes, so the expectation is a number of these were made this year. However, we wouldn't expect them to begin investing until.
There's a perfect example of what the treasurer was talking about, like how long does it take us to get there? So what can this chart tell us about basically the first year after having changed? Are we on track? Are we falling behind?
Each asset class has a different pace. So private equity has taken longer than, say, private credit does. So that's all baked into Nino's model.
When was the last time that we were at $50 a barrel?
We were at 16?
60.
16?
Yeah, I Googled it, and I think it's 2007, but I just wanted to.
Yes, no, that would be low. And just to clarify, 60 is our long-term expectation. You'll notice on that chart when I said our near-term expectations for oil are higher, that reflects the fact that this year and next year, we are in a more supply-tight environment, and that we're expecting higher oil prices, and that is in our inflow estimate. But for the long term, we felt more comfortable using a relatively conservative number, and 60 was chosen for a lot of reasons. One, if you take our forecast from Oxford and our forecast from RISAT and you average the two, you get 60. So then we're sort of in between where our primary forecasters are. So that's one. Two, if you look at break-even prices for production in New Mexico, our break-evens are very low. They're well below 60, and we can still maintain growth at a $60 profile, and you see that in that near term. And so for them, we feel like it is a reasonably conservative number without being too conservative that we're too far on the low end, because again, we want to be conservative, but we also want to be realistic, and so we're trying to be very close. At the same time, if there's variation in that long-term outlook, if it goes from 80 to 60, our production numbers wouldn't change very much, but the inflow effect of that would be larger, and we would rather plan on the 60 now, and as we get closer, if it looks like it's going to be higher, we make that adjustment then.
Yeah, as Don mentioned, with private asset classes, these investments are illiquid. And we can always do more, but it's very difficult to do less without exposing ourselves to risk, for which there's no premium. The next page, so 267 just shows the detail of the prior page. And so here we can see all the commitments made this year, by asset class, strategy, name of the fund, and commitment amount. And then just lastly, I wanted to provide just a quick update on vintage year 2023. And so again, vintage year is defined as the year in which a fund begins investing. So for vintage year 2023, it's comprised of one commitment from 2021 for $25 million, 16 commitments from 2022 in the amount of $1.5 billion. And by the way, this is the second reason the particular current year is more pronounced. And then for commitment year 2023, 8 commitments totaling $1.1 billion. So in total, 25 commitments, roughly $2.6 billion amount. And then when we take a look at what's left over from commitment year 2023, so while there's still a month or so left remaining in the year, we have 38 commitments totaling $4.5 billion. Now, if the remaining funds, if they don't begin investing by year end, they'll be rolled forward to next year. And of course, this serves as a reminder that we have control over commitment year, but we don't have control over vintage year. Are there any questions?
Wow. My response is wow.
Madam Chair. Yeah, I just wanted to make a few comments and thank Don and the team for putting this together. This is a really impressive analysis, and I think it speaks to a lot of different things that we have to consider at the SIC. When I see these charts, I'm just curious as to what's going to happen after 2050. And I know it as you get farther out, it's harder and harder to make projections on those things. But for all intents and purposes, I see oil and gas, really decreasing and continuing in that way after 2050. So I think that informs everything that we do at the council in terms of making prudent investments and looking at what we're doing with that. So I just found that really fascinating. The other thing that I think about is I see this report being a critical element in any strategic planning that we do on the council. In terms of a strategic plan, I think that this is going to be some critical information on how that comes together and how we plan for the future of investing the funds and the recent large increases in inflows to the SIC. And so I do want to ask that we do really think about how we can incorporate this into our strategic planning, to use it as a real baseline. Because what you said, Madam Chair, earlier from the Goldman Sachs report and then this information, if you put two and two together, you can kind of see what we need to be thinking about in terms of what the SIC has to do with prudent investments that we're making. I'd also like to see, if you can at some point, more of a national and maybe global analysis on that sort of oil and gas production in the United States and globally, and to see what that looks like. I don't know if it would be of interest to any of the other members, but I'd kind of like to see that. So however you can think about maybe doing that.
I'm curious, widely different from what we're projecting from New Mexico. I would assume that the trends are pretty consistent.
Oh, well, actually, New Mexico, along with Texas, are leading the nation in terms of production. Most of the growth in production is still coming out of the Permian Basin. Eagle Ford is mostly leveled off. Bakken still hasn't recovered from COVID. So a lot of the growth that's being projected over the next several years is driven by New Mexico and Texas, and largely, specifically Delaware and New Mexico. So when you look at the trends for New Mexico, they actually look very different than the nation overall, where long-term if you look at, and I'm more than happy to bring this to the council, but if you look at the long-term production profile for the U.S. versus the long-term production profile for New Mexico and Texas, we have growth for longer. Our peak is later than the U.S. because those other basins start to drop off faster than the Permian.
What about globally?
Which one?
Globally.
Globally, there's still quite a bit of production that's anticipated coming out of, say, OPEC countries. I'd have to look, but I can bring specific profiles for those, so that you can see each of those. The one chart I just want to draw your attention on, page 261. This oil demand chart, that's a global oil demand chart, and you'll notice that production chart is sort of, that line is somewhat similar to those New Mexico, but not quite. There's differences in timing and length of time for each of those, because that's a global scenario. But those are things that we can certainly break out and bring to you.
Is that all, Member Chance?
Trying to turn on my mic here. That's about it, but I just do want to commend you, Don. This is excellent. Well done. Good work. Thank you.
And Nino. So, I think, like, this could be a real roadmap for us in terms of what to anticipate and how much risk we even may want to take on while we're anticipating these changes. I'm just going to add two more. I'm a broken record like many of us are. The chart on 262, what that tells me is that while we are still producing, and New Mexico is a cheap place to produce gas, or to produce oil, and gas, actually both, we should really be considering a higher royalty rate. The state should be considering a higher royalty rate. So I'm wondering if this presentation is going to go before the legislature, or if they know about it, if they...
We've got no plans there.
Well, to a degree, yes, we have been in communication with the head of Senate Finance. He's asked for this information, and we said we'd provide a copy. I suspect that there will be additional discussions after that.
I would actually prefer, I would encourage them to have a full presentation, not just a copy.
Senate Finance or how?
And Senate Finance. And then the other thing I will say is that when I was in front of the legislature for my budget hearing, I included some of the slides from the Carbonomics study that I referenced. And we got on a discussion about possible legislation to change how we deal with the inflows from renewable sources, to possibly have those also go into the permanent fund. They're not going to be at this level, but they may at some point approach our historic oil and gas level annually. So I think every little bit, as we're anticipating this drawdown.
Madam Chair, just one comment on the investment side with this chart. screams at us is we can take a little more investment risk
Okay.
than our peers.
You heard it here. Let them
And
Wait a minute, what did I just hear?
This spring we'll be,
Say it one more time, you didn't hear.
this spring we'll be bringing you some options.
So what this screams at us is that we could be taking a little bit more risk, is what he said.
Can you also mention, Don just got awarded?
Yes, Don was just awarded, Next Gen, is that what they called it?
I think they called it Rising Star.
Rising Star, Next Gen's the other man.
Yep, Rising Star.
Got a Rising Star award.
And she is.
Congratulations. Further questions on this presentation?
Madam Chair, I have one question if I could. What is the average maturity of these investments in these private equities?
Yeah, Madam Chair and, Member Summer, yeah, so it varies by asset class. So our private equity investments tend to be the longest, so we'll see 10, 12-year wrap-ups in those funds. And usually we have most of the money back by year 7 or 8, and then kind of 3 or 4 year tail after that. The faster returns tend to be in private credit, and the others in between those two.
Thank you.
All right, thank you all very much.
Madam Chair, as we move into this part, just so the council knows, I'm looking at the clock and looking at us, this took about 2.5 hours to take care of these, 9 investments. So, I'll leave it up to the chair to determine if we need a aisle break or anything of that nature as we come up. I've also asked the asset class managers and the presenters to condense their presentations as much as possible, and to also let us know if any of the investments that we're making have any connection to the idea of re-ups or bump ups or fill ups or anything like that. But this is going to take some time. This is the heart of what we do, and so everybody grab on, grab a hold.
All right, great. So, Mr. Lawson, you have your marching orders. And, we will ask that presentations be kept, to a decent length. I know you all, came here in person, you've been waiting very patiently. I appreciate, having you here. Welcome.
Thank you. We appreciate being here.
Thank you, Madam
Oh,
Chair.
I'm sorry, agenda item,
3D.
3D.
I think it's on page 268 of your diligent material. So with me today, from Nikita, we have Mary Bates. Mary, I apologize, you don't have a sign, that's on me. We also have from Golub Capital, Ross Vanderlinden and Greg Cashman with us today. So this recommendation is by staff and in consultation with Nikita. We are recommending a commitment of $400 million to Golub Capital's direct lending strategy. This lending strategy is to middle market corporations. SIC has had a long relationship with Golub. Golub has a long 25-year plus history as a major player in the direct lending world. This Golub custom proposal meets several goals for private debt. One, it allows for capital recycling. There's downside protection given Golub's very low default history. The majority of the return will be from fixed income. And then the added benefit of immediate deployment. Essentially, this is kind of a re-up, but we're moving to a different kind of structure. We're moving to an evergreen type structure. But the underlying exposures are going to be equivalent. And I think the most exciting thing about this commitment is the new structure has a material reduction in cost versus our prior structures with Golub. Essentially, we're getting a 40% decrease in the cost structure, and that is material. And in addition to that, the way it's structured, there's going to be a feature that the costs are going to trend downward over time. So, really happy with the structure. So with that, I'm going to turn things over to Mary.
Great. Thanks so much, Tom, and I guess apologies, this is not a risky strategy. It's the antithesis of that. So I'm going to keep my comments comments quickly. So what the custom structure is, it's into a fund called GSIL, which is a feeder vehicle into the Golub Capital Partners, which is the manager's flagship direct lending strategy. As Tom's already mentioned, the GCP strategy focuses on making senior secured floating rate loans predominantly to North American middle market companies backed by private equity sponsors. So Golub focuses on companies with $10 to $100 million in EBITDA, typically in recession-resistant industries with a particular focus on software, healthcare, financial services, and specialty consumer. The focus is on return consistency through limiting credit losses. What really makes this strategy different is the fact that LPs are buying into an existing portfolio of loans. And there are a number of benefits associated with that we'll talk through at a high level. So as Tom has already mentioned, this is a custom proposal. So in addition to lower fees, which we won't go into because we are in public session, there are a number of benefits associated with this proposal. One, you're investing into a fully deployed existing portfolio with a current yield of approximately 12%, with very limited problem credit. So a lot of our due diligence focused on what you're buying into to make sure that the existing portfolio does not have impairments, and there does not appear to be many impairments at all. Two, another key advantage of this proposal is that the financing that was secured and is in place by the manager, some of that was secured in a lower interest rate environment. So not only are you buying into assets that are higher yielding, you're buying into a portfolio that has lower financing costs. So you're both benefiting on the asset side as well as on the liability side. So that's very attractive and obviously difficult to do in this environment. One of the key things, one of our mandates, as we understand it from Tom and Vince, is the importance of recycling. What you're trying to do in the private credit program, in part, is just simply compound interest. And because you're in such a cash flow positive position, we want to recycle rather than take the distributions. And so that's not something that's available through the GCP series, but that is available through the custom mandate and the custom proposal that Golub brought to the table. Another key advantage of this proposal is that you are going to be immediately deployed. So we've been talking a lot today, and as we have at previous meetings, about how you want to get capital put to work quickly. 100% of your capital is going to be deployed day one, as opposed to being ramped up over time. Another benefit of this proposal is that Golub expects to draw 100% of your capital, something that's not discussed often, but is one of the differences in the private credit or in the private market space, is typically 100% of your capital is not drawn. In this case, it will be. So those are all positives associated specifically with this custom proposal. So just a couple of quick points. I won't belabor this. Golub's track record, I think, speaks for itself. They've had basically 2 basis points of losses since 2004. They've had no payment defaults since COVID. There are a number of reasons behind that, but a lot of it ties to the focus of their strategy, which again is senior secured lending to private equity companies. A lot of it ties to their scale and their incumbency. So they've been doing this for over 25 years. They have 350 private equity sponsors. They have 250 repeat sponsors. We can talk a lot about and go through a number of statistics, but they're one of the largest direct lending managers in the industry. We've already highlighted some of the financing benefits, so I'm not going to go into detail, although I'd be happy to if there are questions from the committee on that. One of the things that I believe the treasurer always appreciates is that we do highlight concerns with any offering. You know, there are always pros as well as cons. So one of the things with this structure, it is the mousetrap, if you will, that makes GCP a different offering than many competitors in the space, is that this vehicle structure does date back a number of years, and so there are some legacy issues as we identify them associated with this vehicle. One of which is the manager does not fully pass through deal origination
fees to the fund. That is now industry standard. They split the deal fees for unitranche investments. We can go into more detail on that. They've addressed that in part through the proposal, which again, we won't go into details on because we're in public session. Another thing that while it remains industry standard, more and more funds are moving away from it, and this is very important to highlight. Fees are charged on gross invested assets. What that means is they're charged on the levered amount. This is a 2 to 2.5 times levered strategy, so bear that in mind. Again, they have addressed that in part through the attractive terms that they're offering, which is in line with the size of the commitment that they're making. We do have some concerns about the ownership concentration of this organization. It is largely held by the two founders, which are brothers. They have the managers address that in part through some phantom equity, and the turnover rate at Golub speaks to the fact that people, I believe, are largely happy, but certainly we'd appreciate seeing more widespread ownership, as I would imagine some of the senior employees at Golub would as well. We do recognize that it's a challenging environment for private equity, and this manager funds private equity deals. They largely finance LBO financing, and that comes back to one of the things that we really like about the strategy. If you are buying into an existing portfolio that largely does not have any problem credit or a de minimis level of problem credit in it, and we would identify, moreover, that the PE environment likely would lead to a slower deployment of capital, but their structure, we believe, addresses that. So with that, I'm happy to take questions or turn it over to Golub, whatever you'd like.
I think we're for time constraints, let's just go straight to questions, and then you guys can be here to help answer and keep that. Are there any questions?
Before there are questions, I just want to say thank you. David Golub and Lawrence would make sure that they kicked me under the table to say thank you for the commitments that you've made in Golub Capital Partners 11 and Golub Capital Partners 12. We're obviously pleased to be here and our partnership with the group, but I just want to start by saying thank you.
I've been with the firm for 27 years, so there's no issue with retention.
Questions online?
Madam Chair, this was very well received by the investment committee, and we've done a lot of things with Golub before, and I think that we clearly recommend this for approval. Having said that, based on the recommendation of the Council Investment Committee, Consultant Makita's SIC staff, and general fiduciary oversight of RVK, I move the State Investment Council approve a commitment of up to $400 million to Golub Direct Lending LP, subject and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second, Nick.
Okay, we've got a proper motion by Member Lavender, second by Member Tejas.
Commitment needs to be specifically to GCIL. Yeah. It's a new structure. You may have said GCIP, but.
Did I misspeak?
It's not in the motion.
Yeah.
It should be Golub Capital International.
Okay. It may reflect that in the minutes. Make that change, but with that change, recommend approval.
Any discussion on the motion? Hearing none, we'll take a roll call vote.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya. CFA Secretary Wayne Probst.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Yes.
John Bingaman. Harold Lavender.
Yes.
Kurt Summer.
Yes.
6 in favor.
Thank you very much. And I know the treasurer is going to try to come back on via phone. All right, with that, we're going to go now to agenda item 3E. which is, vote on Shankman short duration credit, and the presenter will be Mr. Rockett again. Oh, good, I got it. Name tag.
You do have to, Dr. Oliver here. We're already pretty far.
We're ready? Okay. Thank you, Madam Chair. This is agenda item 3E. I believe we're on page 347 of your materials. From joining me on this presentation, I have Aaron Berman from RVK. I believe Aaron is tuned in with us online. Aaron, are you there?
I am here, yes, thank you.
Thanks, Aaron. And then with Shankman, I have Erica Simpson and Justin Sock. So moving on, this recommendation, investment staff and RVK recommend modifying the Shankman Capital Management High Yield Short Duration Strategy to a broader short duration high yield credit mandate and change the mandate fee structure as well. Within the public debt markets allocation, there are three pools. You've got your cash management pool, you've got your core pool, which is essentially treasuries and investment grade, and then you have your credit plus pool, which houses the high yield strategies, which is a mix of longer and shorter duration strategies. Shankman is the shorter duration strategies. So I won't go back to the restructuring that everyone knows about, but essentially Shankman moved from our non-core as a public strategy that was mixed in with private strategies to our public market strategies allocation. So the liquid high yield market has changed significantly since SIC's first engagement with Shankman back in 2018. Notably, the syndicated bank loan leverage loan market and the collateralized loan obligation market comprise a much larger portion of the market, of the high yield market in both dollar and percentage terms, relative to high yield corporate bonds. Commensurate with that growth in the leverage loan, commensurate with that growth, the liquidity in these markets has also improved. The asset classes are becoming increasingly interchangeable, which has improved relative value opportunities between those markets. Essentially, this proposal is to expand Shankman's mandate so that they can provide them with greater flexibility and increase the investable universe so that they can take advantage of these risk-reward opportunities across the liquid high yield credit market. I just want to note real quick that before passing it on to Aaron, that the Shankman short duration high yield strategy has been the best performing of all of the SIC public market strategies across all time periods. So I think they've proven their worth in credit underwriting. Shankman has been around since 1985. They were really one of the first managers in the high yield market. They currently have $29.4 billion under management. And importantly, Shankman has managed flexible credit mandates such as this since 2010. They're currently managing, I think, about a dozen customized accounts, as well as commingled vehicles. So with that, I'm going to turn it over to Aaron.
Thanks, Tom. I'll try to keep my comments fairly brief here. I just want to summarize a few key points that I think are some important takeaways. I thought I would first start by just reviewing the changes that will be made to the current mandate. The current portfolio does allow investments outside of the index, but it is primarily focused on short duration high yield bonds. Through this expansion, high yield bonds will remain one of the primary allocations, but greater allowance will be provided to the other sectors, those sectors including bank loans, convertibles, and structured credit. The memo already outlines the ranges for how Shankman expects to be allocated over time, is indicated in those ranges. High yield bonds would likely be the largest allocation over the long term, followed closely by bank loans. Importantly, duration will remain low. In fact, the proposed benchmark has a slightly shorter duration profile than the current index being used. It's about 2 years versus 2.5 years currently. So Schengen would have some limited flexibility on where the duration actually falls, but it would effectively have a range of about 0 to 2.5 years. So it's very similar to the current range. The team will largely stay the same. There's one notable change, which is at the lead portfolio manager position. Jordan Barrow has overseen the short duration high yield mandate since he's the lead on that strategy. Jordan will continue to be very actively involved. However, Bob Kirchhoff will now be the named portfolio manager alongside Justin SIC. Justin is the CIO, and he's a portfolio manager on both the multi-asset credit and the opportunistic strategies. Bob is the head of multi-asset credit, very experienced portfolio manager. He's been in the industry more than 30 years. So there's no loss in experience with the change. And in addition, you'll still have the same experienced analyst team who provides the research on the individual credits. The strategy itself is designed to utilize really all areas of expertise of the firm. Shankman only manages fixed income, and in particular, they are focused on below investment grade credit. So this mandate will allocate to each of the sectors where Shankman has expertise. As CIO, Justin then provides really more of a holistic or a macro perspective. He works very closely with Bob to determine the asset allocation and the risk that's taken within the portfolio at any one time. Those top-down decisions are then married with the bottom-up credit selection, which is the responsibility of the sector teams. And then, of course, you have the research that's done by, again, the same analyst team that incorporates their strong risk-focused approach, which limits investments to companies that have been thoroughly vetted and deemed to be an appropriate risk. That focus on risk has been evident in the performance, not only from an absolute perspective, but from a risk-adjusted perspective as well. In the memo, we have a table that provides the absolute return. The absolute performance of the strategies composite versus the proposed benchmark. I wanted to point out that Shankman strategy is normally benchmarked to a 50-50 blend of high yield bonds and bank loans. Although I expect the strategy to be managed very similarly, there is some potential for slight differences in allocations at times, particularly given the duration constraint, which may not necessarily be in place for other mandates. But as you can see from the table, the performance has ranked around the top quartile or better in each of the 3, 5, 7, and 10-year periods, and has outperformed the proposed benchmark in 3 of the last 4 years, with 2022 being the lone underperformer. Again, I just point out that if you compared the strategy's performance to its preferred benchmark, they did outperform in 2022 as well, and were above median versus the universe. From a risk-adjusted performance standpoint, Sharpe ratios have been very strong, again, generally top quartile in all the major trailing periods, and they've been in line or better than the proposed index as well. Information ratios have been very strong. When you use the blended index, that is their preferred benchmark, they've been at least top quartile in each of the same trailing periods. They've been top decile in the 5, 7, and 10-year periods. They've also maintained very positive information ratios when using the proposed benchmark. And again, still in that top quartile range versus peers. So all this to say that regardless of benchmark, Shankman strategy has performed exceptionally well. Just to summarize real quick, through our meetings with Shankman, we've determined the team to be very well resourced with significant experience. The strategy follows a well-defined process that utilizes each of the areas of expertise of the firm, and Shankman has shown a proven ability to generate high income in a risk-controlled manner, offering a long track record of competitive absolute and risk-adjusted performance. We therefore maintain a favorable view of Shankman as a multi-asset credit manager. And with that, I will turn it over to Justin and Erica for their inputs.
Anything you want us to focus on, or?
Well, I'm gonna say in lieu of time constraints again, why don't we just go straight to questions? So if there are any.
We're basically doing 2 things here. We're increasing the.
So we're expanding the mandate. That's one, and this is a slightly more complex mandate. There are some additional asset classes in here. So Shankman asked for a change in the fee schedule. The effective change in the fee schedule is about 2.5 basis points more. So those are the two primary changes. Within the strategy, we're expanding the strategy to recognize the fact that the market has changed. The market in collateralized loans and leveraged loans has expanded significantly relative to your traditional debenture high yield market, corporate high yield market. So the fact is, all three of those markets, the liquidity has increased tremendously, and they trade across each other right now. So to give Shankman more flexibility to have relative value opportunities, this is what we're recommending that we allow them to have that expanded strategy.
Is this like a common practice you're doing with all the folks that you have these agreements with? Like, is this a trend that's changing?
If you want to talk about Justin, if you want to talk a little about that.
Sure, I'm happy to address that. And first, thank you very much for having us, and very much appreciate the 5-year relationship we've had with New Mexico. So thank you for the support of Shankman Capital. What I would say is, over the last 5 years, we have seen significant shift in allocations from single strategy allocations to allocations where investors want leveraged finance exposure, which includes bank loans, bonds, and convertibles. And so there has been a significant shift in our own asset base from large clients who are looking to get a broader level of exposure to all of these markets that we talked about. In context, is the loan market, the bond market is about a $1.3 trillion market. The loan market is a $1.5 trillion market. So by expanding the mandate, you're doubling the size of the asset pool of the markets that we're looking at. And I think a lot of investors have wanted to get that broader exposure.
Just from a more practical standpoint, let's say you've got a corporate debenture with your standard almost no covenants, but you have a bank loan that can give you first lien exposure to the very same credit, and you've got a better covenant package in there, and maybe you have, maybe the debenture is plus 425, and the loan is, we'll call it maybe plus 400, 25 basis points less, and much better protection. That's an option you want to take, and it's every bit as liquid as the debenture market. So.
Hey, Tom, back on the fee, there was a question about the fee. If we run our anticipated portfolio size through those two schedules, it comes out to be 2.5.
That's why I said effective. It's effectively about a 2.5 basis point. If you looked at today's what we have under management today with Shankman.
And our anticipated
in many of the individual groupings, it's a 5 basis point difference. But when you work it out, it actually averages out, Ryan, to about a 2.5 basis point effective difference.
Change, difference.
Yeah,
right.
Yeah, difference.
And the return expectations between the two strategies are different. When you expand the mandate, the anticipation is we will outperform the mandate that we had in place.
Yeah, if you look at the new strategy relative to what our current is, it's persistently outperformed our current. So that the outperformance is expected to more than pay for the additional fees.
And when do you look at this to make sure that it's impact happens? When do we review?
So we can see the Shankman since these are public market strategies, and now they'll be explicitly displayed within the public market allocation. You can see their performance monthly. So we can see it monthly. Call up Ryan McCauley. He does a great. He pulls down all the data for all of our public managers. Very lucky actually to have somebody with a public asset manager background. He pulls down the data for all of our public asset managers monthly, and we sit down and go through all the positional changes, all their risk changes, and what returns they're generating. And then we have a formal quarterly review with Shankman.
Okay. Based on the recommendations of the Council Investment Committee, consultants, RBK, and SIC staff, I move that the State Investment Council approve to modify the Schenkman Capital Management High Yield Short Duration Strategy to a broader short duration high yield credit mandate and a change in management fee structure as memorialized in today's materials and as reviewed and discussed by the council today.
I'll second.
Thank you. We've got a proper motion by member, Allen, a second by member Lavender. Any discussion on the motion? Hearing none, if we could take a roll call vote on the motion.
Commissioner Stephanie Garcia Richard.
Yes.
CFA Secretary William Probst.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Here, yes.
Don Bingaman. Joe Lavender.
Yes.
Kurt Summer.
Yes.
6 in the affirmative. Motion passes.
Toya, can you put me down as yes? The treasurer would like to be put down as yes.
I will absolutely do that.
Thank you.
Thank you.
We can have now, Northbridge, Mr. Sable and Townsend will be on agenda item 3.
So, Madam Chair, we're here to recommend an investment of $100 million in Northbridge Partners Fund 4 and $50 million into a co-investment vehicle. At Member Lavender's urging, we'll try to keep comments brief. I think what I'll do is a couple of introductory comments, and then maybe hand straight over to Greg Lauze, L-A-U-Z-E, for his comments, and we'll let Townsend's written work stand for itself unless there are other questions. Jumping off, the fund is an industrial infill strategy targeting returns in the low to mid net teens by investing in a portfolio of small to mid-sized last mile industrial real estate assets located principally in the Northeast and Mid-Atlantic regions. Key concepts underpinning this investment recommendation: one, we expect the fund to continue to benefit from the continued growth of e-commerce sales and the ongoing trends in industrial more broadly. High population density markets like those in the target geographies of Northbridge tend to garner the attention of e-commerce companies seeking to develop supply chain capabilities in support of expedited delivery options. We think the GP has an advantaged sourcing model. The vast majority of transactions that Northbridge has entered into involve non-institutional owners and occurred outside of auction processes. So an opportunity to drive good entry prices and subsequently good returns. The GP is vertically integrated specialist in last mile properties. As a developer and owner operator, it avoids the added layers of fees that would be characterized by a GP using operating partners. Prior two vintages, vintages 1 and 2 in this strategy were top quartile performers. The third vintage has not had sufficient realizations at this point to make any strong comments on performance. With that, Greg, I'll hand over to you to do the overview on the strategy.
Thank you, Keith, and thank you to the council for having me today. Again, my name is Greg Lauze. I'm a managing partner and one of the co-founders of Northbridge, and we appreciate the opportunity to be considered by the council. I'll be brief because I know we've got a full agenda. Real quick on our strategy, what we do, where we do it, and how we do it. We invest, as Keith said, in small to mid-sized logistics assets near ports and populations along the East Coast. These assets play a critical role in the supply chain, as highlighted by some of the challenges coming out of COVID. We focus on specific markets that deliver both last mile to consumers and businesses, but also, of course, situated near ports and benefit from all the challenging zoning regulation, which limits new supply. There's also wetlands issues and population density in our markets that limit new construction over time, which we believe will continue as it has in the past with the outsized rent growth. How we acquire a little bit different than some of our competition. These are small assets, so the last mile segment overall tends to trade in larger portfolios, specifically when core and core plus large funds are acquiring them. We acquire them one by one. Our average equity investment is $10 to $12 million. We have a fully vertically integrated team that will then try and add capital, increase the cash flow of those, and we believe it translates to pricing. Once we've done that, we will seek to exit in portfolio sales. So we'll do 50 to 70 transactions on the way into a fund. It could be 1 to 5 when we exit that fund. We don't underwrite for that portfolio premium, but we believe it exists. Couple comments on the markets overall. Continued e-commerce growth as evidenced by some of the numbers over the weekend continues to grow. Demand, domestic manufacturing also has been a boost for our segment as we see more and more companies bringing manufacturing back abroad. And overall, our markets are hovering around 95% occupied, so maybe slightly lower than where they were a couple months ago, but still very, very strong demand from the tenants. And at the same time, so you've got a good operating environment. The capital markets are highly dislocated, and that's leading to construction starts being down across the U.S. by 70%. So as we look out a couple of years, we feel like solid demand, some secular trend growth, coupled with a lack of new supply driven by capital markets events, is favorable. And last comment is we've got this strategy that we've been executing over the last decade, but there are some cyclical opportunities today, particularly from owners who took on too much leverage, some 70, 80, 85% loan to cost, loan to value in the last couple of years without proper interest rate protection. That is providing some opportunities for us on a cyclical basis to step in with good capital and acquire at favorable prices. So I will stop there and take any questions.
This is $100 million and then a co-invest. Lozy. This is not evident.
You would not guess that.
So I don't know how long you've been sitting here. We had a conversation earlier just about leveraging investment know-how from folks that we are investing with. And there's this Coffee Connectors program. Can you talk about that?
Sure. We started a Coffee Connectors program. I was first generation of college in my family and didn't really understand how the finance world worked, and we realized that there was an opportunity to bring in interns. There's a lot of focus on getting kids to college, but from there and getting into the world of finance was a little bit of a black box. And so we bring in and have at least half of our summer interns as part of this first gen Coffee Connectors program. And we give them internships and try and help place them in industry. The Coffee Connectors during the year outside of that is we ask individuals in different areas to help kids that are want to be in different fields. Say, will you take one coffee? We have coffee with them. Open up your network. Just costs you 30 minutes of time, and we can really have a much larger impact than we can do on our own. And it's been a great program. My business partner Dean Atkins was the engineer behind it, and
we may be curious to hear about.
Would love to provide any other detail, and we're fortunate enough to get an investment with you. We would love to spend time here and specifically within our expertise of the logistics world, and if you're trying to get next generation.
That would be appreciated.
We would love to do that.
How come you're only northeastern focused? But have you thought about the West Coast and or the border with Mexico?
Yeah, so we're primarily East Coast, Northeast, and South Florida. So we do, we pick certain markets. We skip over some like Atlanta that have just more supply issues and more construction, generally easier to develop. So
covered our East Coast desired markets. Long term, we do have a desire to be essentially on the West Coast. They have a very similar, ports and populations. We're just growing at a methodical pace, and key for that is getting people on the ground. We're close to our assets, and so we need to build a team.
Questions from council? Questions online? We have a motion.
Madam Chair, based on the recommendation of the Council Investment Committee, Consultant Townsend, SIC staff, and general oversight of RVK, I move that the State Investment Council approve a commitment of up to $100 million to Northbridge Partners Fund 4LP and $50 million to a related co-investment vehicle, subject to and contingent upon New Mexico legal requirements, New Mexico State Council policies, Investment Council policies, navigation of final terms and conditions, and completion of appropriate paperwork.
Second. Nick.
All right, we've got a proper motion by Member Lavender, second by Member Tejas. If we could, is there discussion on the motion before the council? Does everyone understands the motion? A total of $150 million. All right, if we could have,
Commissioner Stephanie Garcia Richard. Treasurer Laura Montoya.
Yes.
CFA Secretary Wayne Probst. Nick Tejas.
Yes.
Catherine Allen.
Yes.
Harold Lavender.
Yes.
Kurt Sommer.
Yes.
Motion passes 7-0.
Thank you. You guys.
we'll hear from Brooke, Climate Infrastructure, Mr. Sable, and Mercer. Sorry, agenda items for those following along, 3.
So, Madam Chair, we're here to recommend a further commitment of $25 million each to Sandbrook Climate Infrastructure Fund 1 and the co-investment vehicle. Both of these have already been established and were voted upon by Council in November of last year. You'll recognize that Sandbrook seeks to earn mid to upper teens gross returns, investing in a portfolio of core plus to value add energy projects across segments, including clean power, transmission, storage, energy use efficiency, low carbon supply chains and services and such. This was the management team that had the connections to Pattern Energy. Very briefly, key considerations that we were looking at here. Sandbrook has had a very successful capital raise. At the time we were having our first conversations, we expected that $1 billion would be a pretty reasonable threshold for them. They had set a hard cap at $1.5 billion, and they've come back because we would represent the final $25 million to allow them to reach their hard cap. In less than a full year, Sandbrook has committed 50% of the capital that we had initially allocated to the fund. That's a capital deployment pace that actually exceeds what our initial expectations were. The team was small at the outset. It's on plan with expectations as they stood at the time of the initial investment. The fund has made 3 investments to date. All of those have been underwritten consistently with the underwriting disciplines of the GP. One of those has had a history long enough to speak to the track record, and that one is outperforming underwriting assumptions by a significant margin. A key benefit of this upsize of our allocation to Sandbrook will be enabling us to get into a lower fee tier that will apply across this new capital and the initially deployed capital with the GP. Again, this GP has connections to the state, and while it's impossible to call which investments may ultimately be made here, we think that topping up at this particular point in time will help solidify a relationship with a GP who we think will be important here over the long run. Our total allocation to Sandbrook, giving effect to this incremental $50 million, would be $100 million in the main fund and $100 million in the co-investment vehicle. Have Amy Ridge here with Mercer to add any
any other color that you may, wish to get on details of the investments made to date.
Yeah, it's a good opportunity, to really put some additional capital into a newer firm that's really proven themselves out over the past year. They've done a few different wind turbine investments to date. They've also done a utility scale battery facility, which is going to help with grid stabilization so that we can continue to increase the use of renewable energy. So the investments to date have been attractive, and we think that this is a good opportunity to go into the fund, and then that also allows us additional capacity to go into their co-investment fund to top up there as well, which is a no-fee-no carry basis. So not only will it bring down your fees on the main fund, it increases our ability for no-fee-no carry co-investment.
All right. Based on the recommendations of the Council Investment Committee, Consultant Mercer, SIC staff, and general fiduciary oversight of RVK, I move that the State Investment Council approve a commitment of up to $25 million each to Sandbrook Climate Infrastructure 1, LP, and the related co-investment vehicle, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
All right. Proper motion by Member Allen, second by Member Lattner. Any questions on the motion before us? $25 million in the Climate Infrastructure Fund and the Okay.
Commissioner Stephanie Garcia Richard. Treasurer Laura Montoya.
Yes.
CFA Secretary Wayne Probst.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Yes.
Harold Lavender.
Yes.
Kurt Summer.
Yes.
Motion passes 7-0.
Madam Chair?
Yes, Member Bingaman.
John.
Yeah, I just, Brent, I think you missed me on that vote and the prior one. I wanted to record a yes vote on both of those motions.
My apologies.
No problem. I am going to have to disconnect in about 25 minutes, but I'll be able to stay on until then.
Thank you, sir. All right, let's go now to 3H, Bain Capital Global Situation Special Managed Accounts. We're going to hear from Mr. Cassidy and Mercer.
So Richard and I will try to be brief so you can hear from the managers directly. We're bringing three investments for the national program this month. They kind of maybe have some non-obvious similarities, so I'll just point them out. Each fund, we're getting some visibility into deals. These funds are already partially invested, so we have a sense of the types of deals they're putting in the fund. And they'll already be out of the J-curve or have some visibility to be out of the J-curve by the time we invest. Three, we're starting to see some really interesting types of transactions had a huge regime change with an increased cost of capital, and we're seeing some interesting opportunities that, 3 years ago when interest rates were zero and credit spreads were tight, that didn't exist. The first investment we're bringing is Bain Capital Special Situations. Bain, on the private equity side, is one of our core managers, so you know them. You've seen some of their investments, including Bain Capital Insurance earlier this year. Bain Capital Special Situations is another group in the firm that takes advantage of things that don't necessarily fit perfectly in a bucket, somewhere between credit and private equity. And we haven't done an investment like this in a while. Our last investments in the special situations bucket within private equity were in 2017. That's reflective of the fact that, frankly, the economic environment wasn't conducive to this type of strategy, and that's changed dramatically over the last year and a half. We have some legacy positions in there, including traditional opportunistic credit funds, secondary funds, and also a fund of funds. But that's not really reflective
reflective of where we're going to go with this going forward. This is intended to be a strategy, like somewhat of a hybrid strategy, where you can earn equity-like returns, but with some downside risk while retaining asymmetry to the upside. We're recommending two things this month. We're recommending a $400 million SMA, which will invest alongside Bain's Global Special Situations Fund. And we alluded to this last meeting when we discussed the principal investment programs, and we recommended the SMA with Mercer. We're also recommending a $100 million side-by-side co-invest vehicle that will invest in select types of deals that the fund does, in particular the strategies that are more equity-like. There's two things to point out before I pass it to Richard. The current environment has allowed some interesting opportunities to earn great risk-adjusted returns with downside protection, and without necessarily sacrificing return. Bain, unlike a lot of strategies right now, which are struggling with the fact that the cost of capital is so high, they actually have quite a deep pipeline. And two, and this goes along with the pacing, as we look to ramp the private equity portfolio, this strategy actually has a good opportunity set right now, so we can put capital to work at attractive rates of return. Why the SMA? Really just it's an opportunity to use our capital size at this point to reduce fees, negotiate a slightly lower fee, as well as it allow us in the future, to the extent the environment changes to something different, we can work with them to customize the exposure in the fund, given they have a broad mandate. I'll pass it along to Richard to go through the fund in more detail.
Yeah, and as Chris mentioned, Bain is an existing relationship in the national program. You have exposure to multiple strategies, and to put it in perspective, in aggregate, those have generated 16.5% net IRRs for you as of June 30th, 2023. So it's been additive to the overall performance of the national program. From a strategy perspective, we like this SMA in the special situations category of the national private equity program, since it is expected to have lower correlation with the other sub-strategies that we focus on, mainly buyout, growth, and venture capital. And that's good for diversification. Bain has a flexible mandate with this special situations fund, where they can focus on different investment themes and geographies and can adapt to different market conditions. We really like that Bain's an established alternative asset firm, where they're really taking from all the different parts of the organization and the expertise that they have to manage this strategy. The strategy, there's 5 partners on the senior leadership team that average over 21 years at the firm. They use their global platform to source the investments. And they also have an experienced team of operating resources as well that can help with operational improvements where needed. And we think Bain has good alignment with investors too. They've kept ownership within the firm's employees, which creates good alignment. The track record's been attractive for the Global Special Situations Fund Series, with the first 2 funds tracking in the first quartile right now. And we're recommending the $400 million to the SMA and $100 million to the sidecar co-investment fund as well. And I'll turn it over to Jonathan Levine, who's one of the co-managing partners at Bain Capital.
Thank you, and thank you for taking the time. I know it's been a long day. I'm Jonathan Levine. I'm co-managing partner of all of Bain Capital, and I also oversee the part of the firm that has special situations and help found it. To step back for a second, we very much appreciate the relationship with New Mexico. If you look at our firm value statement, the first thing in it is we form lasting partnerships with each other, with our management teams, and with our investors. As such, we have remained private. We fully intend to remain private. The firm is wholly owned by all the 150 partners of the firm, and we have no outside capital either. We've never sold a minority interest. Secondly, the partnership ethos we have at the firm helps drive the success of this business, because this business not only sources as a regular business would do with lots of people out in the world and 16 offices and 140 people just focused on this business, but it also works with all the other parts of Bain Capital, because this is the part that has the most flexible amount of capital. And for a whole variety of reasons right now, many of which have been talked about earlier today, multiples are very high. Yield curves are both high and inverted, and the availability of capital is quite light. The people who can provide capital solutions, which are highly negotiated structures, can be hybrid equity, can be debt with an equity component, can be equity with a guaranteed downside. We can do this across the globe. We also invest against hard assets. We might find a team that we think is valuable, that is underrepresented. An example would be freighter aircraft during the COVID timeframe. And then we do some traditional distress, but we think that that's a very market-sensitive part of the business, and that's somewhere between 10 and 20% of the strategy. We are particularly excited about this opportunity now because there's been so many people who have retreated from providing capital in the market. There are so many very narrow strategies that they try to be very large but very narrow in what they do. So you see that more often with public companies. And we are able to do things ranging from structured equity investments in the division of a Fortune 100 company to a preferred equity in a family-owned business where we could send our operating people in and help bring it to the next level to buying airplanes. And so we have been able to do that successfully. We have a whole series of global, this is our second global version. We also have 4 regional versions, 2 in Asia, 2 in Europe. And lastly, what I would say is that we believe very much in eating our own cooking at our firm. And our commitment to this series is the largest commitment we've ever made to this strategy by more than double.
Ready? Okay.
Hold on. Any questions? Okay.
I was going to say, Madam Chair, this is an example, last month we approved the SMA process, and this is a perfect example of how that can work, and I think it gives us terrific flexibility and opportunity, and the committee felt the same way.
Member Allen.
All right. Based on the recommendation of the Council Investment Committee, Consultant Townsend, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $400 million to Bain Capital Global Special Situations, SMA, and up to $100 million to the related co-investment vehicle subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
We've got a proper motion by Member Allen, second by Member Lavender. Discussion on the motion before the council. Hearing none, we'll have Fred take a roll call vote.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Be off now.
CFA Secretary Wayne Probst.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Yes.
Don Bingaman.
Yes.
Harold Lavender.
Yes.
Kurt Summer. Kurt Summer.
Yes, yes. Yes.
Motion passes 7-0.
Okay, very good.
Thank you. We look forward to updating you on future success. Thank you.
Thank you.
Same here. We look forward to being updated. We'll have Mr. Catherine remain in place, and Mercer, and we're going to take the lead edge, or lead?
Lead edge.
Lead edge, okay, great.
So again, I'll be brief. This is a group that we've gotten to know over the last year, and not dissimilar to what we talked about with Bain. We started to see the type of differentiated deal flow they were doing in the growth equity space, and really wanted to figure out a way to put capital to work in the fund, and they were kind enough to figure out a way to carve out a small allocation for us to start a relationship in a late close. I'll let Amy talk in more detail about them, but PitchBook recently ranked them the top performing growth equity manager in their league table. So we're really excited to start a relationship here, and excited to have Brian tell you about some of the things they're doing on the secondary and special situations side.
Great, and our report starts on page 498. This is a new relationship for the national program, and it will fit into your growth equity category. LeadEdge has a very long history. They raised their first fund 12 years ago, and they've been executing the same strategy ever since. They've also had very long-tenured senior leadership. The 3 founding GPs still manage and lead the firm today, and they've grown the investment team to 30 professionals. What really differentiates LeadEdge is their strategy. They very much focus on finding the best companies that fit within their target profile and then figuring out creative ways of getting access to that company. So they will do things, right down the fairway, like lead the growth round of equity as the sole investor, but then they'll also do things such as go in as part of a consortium alongside other investors. They will execute secondary transactions in legacy funds that have a position in that company where that would give them some equity. They'll buy equity from founders and early employees of a company that are looking to cash out some of the shares from when they started. So that really differentiates. They will build a position. It's really about finding a way into the companies that best fit their mandate. And this strategy has consistently generated strong returns. You'll see those on page 508. And lastly, with Fund 6, they've actually already made 7 investments. So we're going to get some capital on the ground immediately. They've also already had a few early write-ups. So you're also coming out of the J-curve. So not only are you deploying capital, we are able to get portfolio visibility into some of the investments in the fund, and you will have the positive effect of having immediate write-ups in the portfolio. So we are recommending up to a $50 million commitment to LeadEdge Capital 6, and with that, I will turn it over to Brian Nader, who is one of the original general partners.
Thanks so much for having me today. It's a pleasure to meet everyone. So I'm Brian. I'm one of the managing partners at LeadEdge Capital. We're a private equity investment fund. We invest into growth stage businesses in the software, technology-enabled service, and internet ecosystem. I'll start with a little bit about myself, just so you guys have a bit of familiarity, because as Amy mentioned, we have a long tenured history together as a management team. I started my career doing growth stage investing at Bessemer Venture Partners. It was there that I met my current partner, Mitchell Green. That was 20 years ago. Bessemer hired us to do cold calling. They wanted us to increase their top of the funnel. And over a 3-year period, Mitchell and I cold called businesses. We left over 20,000 voicemails for businesses. We wrote 20,000 emails to businesses. We had 7,000 substantive conversations with businesses, and this is when I was 22, 23 years old. I really cut my teeth there, and as we always say, it's much easier to spot a great business after you speak to 6,000 really mediocre ones. And so we think that we have a unique insight. Over 13 years ago, Mitchell started LeadEdge. I joined shortly thereafter, and our third partner, Neiman Mehta, also joined, and we've been building LeadEdge ever since. The 3 of us run the firm, own the management company, and build it brick by brick every day for the last number of years. Historically, we've raised over $5 billion across 6 private equity funds. The cornerstone of our approach is a highly value-added LP base. The majority of our LPs are actually individuals who can be strategically helpful to our portfolio companies. We currently have over 700 individual LPs who have built, run, and managed some of the world's best businesses. The LPs help us throughout the life cycle of investing. On the sourcing side, we have 18 professionals at the firm who do the same cold calling job that I did 20 years ago. This creates a tremendous top of funnel. The sourcing effort is augmented by these LPs who often introduce us to businesses or can help us break through to hard to crack businesses and get us in front of things. On the diligence front, the LPs help build our conviction in our investment activity. You can imagine we were looking at investing in a restaurant software business. We went to our 700 LPs. We spoke to 20 of our LPs who had run large restaurant chains, and they gave us unique insights very quickly and got us up the curve on learning about the sectors. After we make an investment, the LPs help add value to our portfolio companies. They assist with recruiting.
They assist with strategic advisory. They assist with customer and partnership introduction. Unique LP-driven strategy I enumerated is coupled with a focused investment mandate. Each year, through our material sourcing efforts, we speak with over 8,000 companies in the software, internet, and tech-enabled services sectors. We take a Moneyball approach in which we first look for companies that meet a set of financial metrics that we've defined, and we call it the Lead Edge 8. You have our framework in our presentation, but I'll enumerate it real quickly. We're looking for companies to meet the following: $10 million of revenue run rate, 25% plus revenue growth, 60% gross margins, limited customer concentration, recurring revenues, high retention rates, strong capital efficiency, and profitability. If you cold call companies in our sector, you'll find out that about 1% of all companies meet all 8 of those criteria. We focus our efforts on companies that meet more than 5 of those criteria, which is kind of like the top 10%. And that gives us a large enough pond to cast our reel and fish and ultimately find opportunities. We track all of these metrics religiously, and we use this screening, these 8 criteria, to avoid distraction. It's really easy to get distracted in our world by the next big or cool idea. That's just an idea. Nothing shiny, no shiny objects at Lead Edge. The Lead Edge 8 provides us the framework to stay on track and out of trouble. Upon finding companies that we like, we figure out how we want to invest. We use an analogy of the house to describe our philosophy. And Amy sort of touched upon it, but I'll go a little bit deeper for the next minute or two. Oftentimes, we could go through the front door. This is the path of least resistance. We lead a round of growth financing. The company wants our money. We lead the round. It's relatively simple. Sometimes that's not available to us. Company might not be raising capital. There might be nothing to do. So we'll go through the side door. We can identify tired shareholders in the company, old employees that might be looking to sell stock, and we could create bespoke deals with them to buy secondary. Or, if we can't find any of that, we could take the backdoor approach. We might identify an old fund where the company that we're looking to gain exposure to is a large majority of the NAV, and we could buy out LPs in that fund to get exposure to the target company. Our goal is to best identify the attack vector that will yield us the best possible return. In today's market, with so many shareholders, GPs, and LPs looking for liquidity, our strategies around buying secondaries, that side door, backdoor strategy, have been amplified, and we're seeing tremendous opportunity here. Overall, we believe that good process yields good outcome. We have a defined strike zone. We know exactly what we're looking for. From a structure perspective, we often invest in companies with preferred stock. This limits our downside and allows us to capture equity upside. In fact, we have preferred stock in 79% of our existing portfolio companies. This has yielded a consistent set of outcomes with a low loss ratio of sub 4% and strong returns since inception. As I said at the beginning, I'm delighted to have the opportunity to present today. Happy to answer any questions, and thank you very much for your time.
Some story.
Thank you so much.
Wow. So Malcolm Gladwell talked about 10,000 hours, but your story is 10,000 phone calls.
You got it. A lot of phone calls, a lot of talking to companies, for sure.
Questions? Questions online? A motion?
Based on the recommendation of the Council Investment Committee, Consultant Mercer, SIC staff, and General Fiduciary Oversight of RVK, I move that the State Investment Council approve a commitment of up to $50 million to Lead Edge Capital 6 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
All right, we've got a motion by Member Lavender, second by Mr. Secretary. Is there discussion on the motion before the council? Hearing none, if we could take a roll call vote on the motion?
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya. CFA Secretary Wayne Probst.
Yes.
Nick Teas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Joe Lavender.
Yes.
Kurt Sommer.
Yes.
Motion passes 7-0.
Okay, very good. We look forward to this partnership.
Thank you.
Thank you.
So much.
Thanks a lot.
Thank you.
All right, we've got two New Mexico, investment recommendations. We're gonna start first with, agenda item 3K, Osla.
TBG Healthcare AG.
And one more.
One more now.
Oh, I skipped,
3J.
international. Yeah, okay. Agenda item 3J, TPG Healthcare Partners.
So excited to bring this one. TBG is a long-standing relationship. We've invested across a number of their fund platforms, including their growth equity platform and their Asian platform. TBG's always been a very good healthcare investor. What I think makes them so unique is this is something we look for with private equity firms is, or we find really interesting when strategics actually want to partner with them to work on deals together. And they've carved out a really interesting niche where strategics want to work with them, have TBG help them scale and grow a business before the strategic actually acquires it. And that always kind of piques our interest. The fund is roughly 30% invested, so we have some visibility into the goals in the fund, and that those deals are performing well. Excited to start this relationship and pass on for sure.
Yeah, so this is an existing manager. You are into their other strategies, but this will be your first investment in their healthcare fund series. It's going to fit into the buyout category of your portfolio. TPG, very long-standing firm, originally founded in 1992, and they have a large and senior dedicated healthcare team. It's led by 6 partners, one of which, John, is here with us today, who average 20 years of investment experience in the healthcare sector. So a well-tenured team. And TPG has done very well with their healthcare investments, which has led to the creation of this new dedicated strategy. So they've done one healthcare fund specifically as this, so this will be the second fund in that series. And that fund was a 2019 vintage, which is off to a strong start, including 2 realizations to date. Their strategy is focused on both buying strong companies and making them better, as well as executing more complex strategies where they really need to get in there operationally and make improvements to the company. Fund 2, this fund has already made 3 investments, one of which is already generating a gain. So as I said, the last investment, again, we're going to be coming into some immediate value within the fund. So we are recommending up to a $75 million commitment to TPG Healthcare Partners 2, and I will turn it over to John Schilling, which is one of the partners of healthcare, and Charles Brogue from the IR.
Well, first of all, thank you very much for having us here today. It's our pleasure to tell you a little bit about TPG Healthcare. So just by way of background, so I'm actually a physician by training. I was trained in general surgery. I spent, after leaving surgery, I ended up joining McKinsey and then went to Abbott to run sales and marketing for the U.S. pharma business. So my current role is I co-lead the healthcare investments that we make. I also lead the operations group, which I think is relevant because a big part of what we tend to do is, as Amy was alluding to, is look for companies where it's kind of a good to great story, where we're making investments in the companies that are in very attractive markets and that need operational change and transformation that can help build their position over time. I think if you look over the last 20 years where our team has been investing, we've invested about $30 billion in that time, and on average delivered very strong returns with very low loss ratios. And I think that's most notable, I think, in the most recent fund, which you can see the returns. A big part of the reason we've been able to do that through both good cycles and bad, through the global financial crisis, through the introduction of the ACA, through COVID, is that we're focused really on companies with great fundamentals that we can build. And we tend to focus on 4 core areas. The first is value-centric care. What that means for us is high-quality, low-cost, accessible care. So that's great. The second thing is that we're looking in the product space for companies that are introducing truly breakthrough therapies. In fact, one of our first realizations in KSP1 was a company that was focused on in the biotech space on gene therapy, but really fundamental changes in the lives of these patients. The third piece is in modernizing healthcare technology. For any of you who have been in physicians' offices, you certainly know that the healthcare space is not one that's sort of on the leading edge technologically, and so we're very focused on helping those companies and practices improve dramatically. And then finally, we're focused on supporting med device and pharmaceutical companies through what we call picks and shovels. So these are companies that serve those others in the space. What we are not doing is taking advantage of wrinkles in the healthcare system. What we're doing, again, is focusing on the fundamentals and building for the long term. In fact, if you look at one of the things that I think is surprising to people, and certainly not the reputation of certain segments, is that we, on average, more than double our investments in R&D in our product companies. In fact, about 150% increase. The reason we're doing that is our goal is to build high-performing, healthy companies, ultimately great companies that strategic acquirers are going to want to buy. And that comes back to sort of the core of what we're trying to do, which is build businesses that people that are leaders in each of the respective spaces on the provider side, on the med device side, on the pharmaceutical side, will ultimately want to own. So as you heard, our current fund, we expect to have about 10 investments in. We had 12 in our last fund. We've already made 3 investments. Actually, turns out now 2 are marked up. So two of the first 3 are already marked up. There you go. We're very close to 2 additional opportunities, I think, that could sign prior to the end of the year, and off to a very, very strong start. So I'll pause there and see if there are any questions. But again, thank you so much for hosting us, and we thrilled to partner.
Question? Online? Question?
Ready? Okay. So based on recommendations of the Council Investment Committee, Consultant Mercer, SIC staff, and General Fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $75 million to TPG Healthcare Partners II, LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
Okay, we've got a motion by Member Allen, second by Member Lavender. Discussion on the motion before the council. Voting on a $75 million commitment to TP Healthcare Partners II. Roll call vote, please.
Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya. EFA Secretary Wayne Probst.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Yes.
John Bingaman. Harold Lavender.
Yes.
Kurt Summer.
Yes.
Motion passes 6-0.
Okay, very good. Thank you so much.
Thank you very much.
Thank you.
Thank you.
All right, now our New Mexico recommendation. So we're on agenda item 3K.
We're recommending 2 investments this month in the New Mexico program. Both have a climate technology angle. September, we were hoping to do this, frankly, all in the same meeting, but it didn't quite work. But in September, we introduced the climate tech sub-strategy in the New Mexico program with recommended commitment to @ONE Ventures. And these are 2 that, one of which invests across sectors, but has been a real, Coastal's been a long-time investor in the space. Starting with Coastal, we're recommending a $75 million commitment across their 3 different fund series. Their seed fund, their early stage fund, and their later stage fund.
But 75 total.
75 total. And as a reminder, this would be a fund commitment under the New Mexico program. And we'll discuss that later with the next investment in a little more detail. Coastal is a multi-stage, multi-sector firm in Silicon Valley. It fits the profile of some of the investments we made earlier in the year. They're one of the most active investors in deep tech and frontier technologies, including climate tech and sustainability, which makes them a great fit for the program. With this investment, the New Mexico program would now have 4 multi-stage VC firms in the program. Crosslink has been an investor in the community for a while now, and in particular the program for a while. Coastal, Lux, and Playground that we brought earlier in the year. It's important to have kind of the best investors in deep tech and frontier tech as part of the New Mexico program, so they can provide that downstream capital. And deep tech tends to be a little more pass it along to Richard for more detail on COSLA, but, looking forward to having Peter tell us about the Spirit.
And we talked in the performance report that one of the areas that we're focusing on is trying to get high-quality, experienced managers into the New Mexico program. And Coastal Ventures is an example of that type of manager that we really want in the New Mexico program. So we're excited to bring this recommendation in front of you. Coastal Ventures began in 2004. They began raising outside capital in 2009. The founder, Vinod Khosla, still the managing director of the firm. He was the founder and CEO of Sun Microsystems, and then also a partner at Kleiner Perkins. And the team is supported by 4 managing directors, 2 of which have been at the firm since the beginning, and the firm's now grown to over 20 investment professionals and over 15 operating partners. And the strategy is complementary to the New Mexico program because Coastal Ventures focuses on deep technology. And also across the 3 funds, the seed, the main fund, and then the opportunities fund, Coastal can participate meaningfully in a company's development from the seed stage, where the firm may even incubate a new company to follow-on rounds in the Series A and later rounds. And Coastal has also had a focus on sustainability and investments that have a positive societal impact. From a track record perspective, returns have been favorable. Fund terms are similar to what we see with other premier venture capital funds. And during the diligence process, we discussed activity in New Mexico, and Coastal Ventures actually talked a lot about their connections to the state, to the labs in the state. And during the process, our due diligence process, they actually invested in the seed round of a New Mexico-based company, which was good to see. So we're recommending a $75 million commitment to Coastal Ventures in the New Mexico program, and I'll turn it over to Peter now.
Okay, well, thank you for having me today. My name is Pete Russell, and I'm one of the managing directors at Coastal Ventures. We have a report, and we got the summary here, so I'll be brief on the background, but happy to talk about Spirit and kind of what we're planning on doing in New Mexico. The firm is long history, 20-year history. We're pretty well diversified. Primarily invest early into companies. Oftentimes, we're the first investment dollar that the company receives. We're talking about working with a couple entrepreneurs in the garage. That happens quite a bit. And one of our core one of the core things that we're pretty good at is helping these early stage entrepreneurs that need to learn how to scale, how to kind of scale these businesses. We have a very long track record of working with research labs, universities, across the states, and helping bring those companies to fruition. We're, as I said, we're a diversified set of sectors that we invest in from a technology perspective. But I think where we're really diverse, or where we're really well known, is in the deeper tech frontier tech areas. And a lot of the reason that we can underwrite those deep tech areas is because of the technical qualifications of our team. You'll see a real difference between the investment team at Coastal Ventures and any other venture firm. We have 10 PhDs on the team. We have 4 medical doctors, and quite a few other engineers. Very much aligned towards technology innovation and not so much towards. That's the firm in a nutshell. Happy to answer any questions about that. As Chris said, as we were kind of going through the process, we had been having more contact with the lab here. We have a repeat entrepreneur in our portfolio that was interested in doing something in climate. We ended up partnering with one of the PIs at the lab, who then, we're very happy to say, decided to leave the lab and become an entrepreneur and launch the company Spirit. Spirit is a direct air capture company, a DAC company. They on the atmosphere. This is really based on a technology innovation that came out of the lab that really kind of mimics the features of the human lung, and it's a very low energy input process to kind of extract the carbon dioxide and store it. We looked at probably 20 to 25 DAC companies over the last 10 years. They've been popular in the news, but we couldn't find any that we thought were economically viable or that could turn into financial investments, which is the core requirement, obviously, of the things that we invest in. So we're pretty excited about this round, and we led we put $500,000 in this company all around, and it's quite a bit of research, and we're hoping that this company. I think that's an indication of how we expect to continue to operate in the state. We have already, over the last 12 months, developed a bunch of relationships, including from the office to a bunch of their entrepreneurial programs. We have people from the team participating in pitch meetings, coaching entrepreneurs. And so we hope that will, over time, yield
good opportunities to work with really smart researchers. In addition, we're starting to work with some of the emerging incubators and early stage firms that are, here locally all the time. That's something that we're pretty good at doing also, and we've done a lot in the past, so we're excited about that. It really feels like there's an ecosystem that's really starting to take shape here, which, you need multiple pieces for the work, and we're happy to hopefully be a part of that. So yeah, happy to take any questions.
I guess just kind of on that same vein, and you've heard, the discussions that we've had now going on 5 hours.
Sorry to hold you for the next show.
And so, we really would appreciate, any commitment that you can make beyond the investment. I'm happy to hear that you are aware of the lab, that you're having conversations with the tech transfer offices. But our economic development department has money specifically around entrepreneurial training, incubating, startups, ensuring that folks get the kind of just training and knowledge they need to get through the valley of death of startups, of having access to investment and capital. So to the extent that you have expertise, probably can't say this, but sort of part of investing with you all is kind of an expectation that you will help us with that.
Yeah, and we fully understand that. We're going to be back next week. There's a formal launch of the new incubator here next week, so we'll be here for that, participating in the panel. Like, it really does take a lot of different components. So part of this is going to be helping build a spirit of entrepreneurship. That's like not easy sometimes amongst these labs, and identifying people there that want to do it. Once those people do it and are successful, then it becomes a students that we can help mentor, and then sometimes it's just finding a particular technology somewhere, whether it's a university or a lab, and even if the PI wants to stay at the lab, we take that technology in partnership with that PI and we build a team around it. So those are all ways that we can kind of go about doing this, and we expect to contribute to this, not just this money.
I appreciate hearing that. Thank you. Just your acknowledgement that that is part of, this partnership is gratifying. Anyone else? Questions?
Madam Chair, based on the recommendation of the Council Investment Committee, and Consultant Mercer, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $75 million in aggregate to 1, Khosla Ventures Seed F, LP, II, Khosla Ventures 8 LP, and Khosla Ventures Opportunities 2 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork. Move it.
Okay, we've got a motion by Member Lavender, a second by Mr. Secretary, and this is a up to $75 million commitment across 3 years. Any questions on the motion before us? Hearing none, we'll take a roll call vote on this motion.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya. CFA Secretary Wayne Prost.
Yes.
Nick Taz.
Yes.
Catherine Allen.
Yes.
Carol Lavender.
Yes.
Kurt Summer.
Yes.
Motion passes 6-0.
Okay, great, and we look forward to the partnership. Thank you.
Thank you.
Thank you.
One more.
Now we've got, another New Mexico investment to dangerous ventures. Yes.
This is a recommendation for a new emerging manager in the program. So you think about the spectrum of types of managers we want in this program. You need, we think we need kind of a lot of different components to this program, but you do need a strong local venture ecosystem that Ward Hendon, who he moved here to Santa Fe 3 years ago after a really successful entrepreneurial career where he kind of went the whole way. He raised venture, it was a company that raised venture capital from some very high, well-known firms and was ultimately sold to private equity. So he saw that whole journey. And Ward now wants to spend the remaining life dedicated to climate crisis. And we've been talking with them about how do we incubate an ecosystem here around climate technology, given all the resources we have in the state, all the research, and I think a great resource for the community, entrepreneurial background to begin to help incubate that. As a reminder, the Emerging Manager Program, we set this up to provide an outlet for local managers to grow into becoming firms and ultimately graduate. What I mean by that is raising money from not just us, but from other people. And these are, we want to be upfront about it. These are riskier, more concentrated investments. They're focused in one geographic region, smaller teams. But, in other states in the ecosystem, other states in the region, including Utah, see the development of local venture capital firms that make their ecosystem. And our aspiration is that several venture capital firms in develop in New Mexico that become regional or national leaders. Dangerous, thought is that dangerous for the climate tech in New Mexico. Somebody on the ground that entrepreneurs can work with and speak to, create, come up with ideas, try to start the business process, which is that's along to Richard.
Yeah, so for the last investment we're doing today, we have Dangerous Ventures New Mexico Fund 1 going into the Emerging Manager portfolio of the New Mexico program. Dangerous Ventures is focused on the very early stage companies, pre-seed, seed companies. Their strategy is focused on climate technologies, which could include a number of different sub-industries within that. And as Chris mentioned, Ward Hendon resides in Santa Fe, and they're raising at least $10 million to focus on New Mexico-based companies in areas. And this is being raised alongside Dangerous Ventures 1, which has a similar strategy, but will focus on a broader geography across the U.S. But having a managing partner in the state will help with the sourcing efforts as Ward participates more in the ecosystem. Dangerous Ventures is a fairly new firm. The firm is led by 3 partners who have operational and investment experience. They take a hands-on approach to working with entrepreneurs. And one of the things that's really interesting about this investment is the plan to start a talent lab in New Mexico, which is basically a program where the team provides coaching and education on various topics to help develop entrepreneurs or employees that can join existing portfolio companies. And as a reminder, with the Emerging Manager Program, we evaluate the fund against minimum criteria that's outlined in our investment summary, which this fund does currently meet. And I'll turn it over to Ward Hendon to learn more about it.
Thank you. It's great to be here. I will just quickly introduce my firm and how we view the opportunity. And Chris mentioned I moved here 3 years ago with my family, wife and 3 kids. Prior to that, I was in California, where I was an entrepreneur. Started my career as a lawyer. Spent 2 years in the law, long enough for me to realize, A, I didn't want to be a lawyer for my whole career, and B, that there were some real systemic challenges that in the sort of business model of big law that we felt technology could help solve. So we created a firm called Axiom Law in New York City in 2000, and I lived through that entrepreneurial roller coaster from idea to exit over 18 years. So I have a real intimate understanding of what it takes to build companies and the sort of different risks along the way. My 2 partners, Mike Lynn and Gabby Derbyshire, also have the same sort of entrepreneurial journey that I did, from a sort of co-founding of a business to an exit. So we really have a very hands-on approach to building businesses, identifying risks, and helping to mitigate those risks. I've been here for 3 years, and I've been really just trying to get to know the ecosystem and the community of other investors, entrepreneurs, the academic institutions, venture studios, accelerators. There's a lot here. The one thing that I have sort of observed that we need the most is venture-ready entrepreneurs. As Richard mentioned, we have this concept called the Talent Lab that we're very excited to roll out at some point, where we will bring in raw entrepreneurial talent, give them 6 months of training in how to be an entrepreneur, and give them an internship, a paid internship with one of our portfolio companies. We think that can help fill a gap in the market here. So yeah, this is our first fund. We couldn't be more excited about the opportunities in New Mexico, and just really appreciative of Chris and Richard and Bruce for spending 2 years with us, getting to know us, and helping shape the strategy for New Mexico.
Ready? Yeah, as long as there's no questions.
Based on the recommendations of the Council Investment Committee.
Yep, hold on.
I don't mean to, given this is, I just want to mention, given this is an emerging manager commitment, SIC staff, is recommending this.
Not Mercer.
It's not.
Thank you for clarifying that.
Okay.
Take Mercer out.
All right, what's that?
Take Mercer out, and just, in other words, just the staff.
Okay, got it. Based on the recommendations of the Council Investment Committee, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $10 million to Dangerous Ventures in New Mexico, 1 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
We've got a motion by Member Allen, a second by Member Lavender. Any questions on the motion before us? Okay, hearing none, we'll take a roll call vote.
Commissioner Stephanie Garcia Richard,
Yes.
Treasurer Laura Montoya, DFA Secretary Wayne Probst, Nick Tejas,
Yes.
Catherine Allen,
Yes.
Harold Lavender,
Yes.
Kurt Summer.
Yes.
Motion passes 6-0.
All right, sir, we, wish you good luck, and,
Good luck.
Thank you, appreciate it very much.
all right, having concluded our investment, items, we're now moving to agenda item 4A, to hear from our Chief Financial Officer, Mr. Schiff.
I will be super brief because we've been here a long time. I'm on page 787, I believe it is. As I normally do, included within my materials, the budget to actual comparison, as well as the investment holdings report. Both of those are available, and if anyone gets back to home or wherever they're going and has any questions, please feel free. I do note within my comments here that Moss Adams will be starting test work on their next 2 quarters of agreed upon procedures here soon. As far as external audit services, we did have an exit conference. I won't say too much about that, other than consistent with what we do in prior years. That report is not finalized until both the state auditor's office as well as DFA is done with their review. It probably is going to be by the end of December, but who knows, it could go into the first part of the next calendar year. I also wanted to point out, if you
look on the investment holdings report, the total assets as of the end of October is $46.245 billion. I've said this a couple times already. I'll say it again. We're quickly approaching $50 billion. I think Don and Nino in their presentations, Don mentioned an inflow from the Early Childhood Education and Care Fund that she was anticipating. We actually did an accrual or recorded a receivable on that as of year end. The funds haven't actually been transferred yet, but her estimate was right on. Actually, it was ended up being $1.149 billion, and that's a number that the DFA controller has us record. And then the Tax Stabilization Reserve Fund, I think Don estimated $960 million, or said that that was the consensus estimate, but that estimate was going to be reviewed in the future. Actually, the receivable a little bit less than that, $723 million, but just those two items, close to $2 billion that will be coming in probably before the end of the year, if not early January. Other than that, I'll entertain any questions.
For B, we'll hear from Member Chayes on the audit committee.
Yes, real quick, as Brent mentioned, we did meet to go through an exit conference with our auditors for the actual annual audit. And that was on November 21st, I believe, where we met with the auditors and they reviewed the mandatory communications that they have to, that they're required through audit rule to communicate to the council. And so we went through some of those things. It was really informative. Some of the areas that they focused on discussing and are critical areas of the actual audit are internal controls, analytical procedures, and substantive procedures. They take a very close look at our alternative investments, which require some more specified types of audit analysis. So we went through all of that, had a lot of good discussion, and the good news for the council to know is that our auditors are really comfortable with the systems, the leadership, the procedures that we have in place at the SIC to limit risk and to assure that they can provide a good audit assessment for us. And they're really impressed by how Brent and his team manage accounting for all the different funds related to the $47 billion that we have, which when they do that and when they have to provide information to the auditors, it's not an easy process at all. It's a heavy lift. And I want to commend Brent and his team for all the work that they do, because it can't go unnoticed, but it's an enormous endeavor and responsibility that they're charged with. And so, it's really good to be in good hands. And so just wanted to share that with the council. At this point, as Brent mentioned, we can't really release in a preliminary way the information other than perhaps going into a closed session, but of course that have to be scheduled, and that's a lot of work that has to happen there. But other than that, we reviewed all of those things in the committee, and things look good from the audit perspective. Thank you.
Thank you, Mr. Chair. As my deputy says, we anticipate a good result.
Very true. Very true. Madam Chair, I want to add to what Nick just said. I think that it's just pretty amazing that Brent and his team, the incredible consistency we have of the kinds of things that they do. And my hat's off. I mean, tip of the hat to him and his team.
just, you know, no exceptions over and over and over, and that's this much money and this many deals, it's pretty incredible.
And unfortunately, you get a lot more recognition when there are bad results.
And the second thing I'd like to say is, this is an all-time record for the SIC, to the best of my knowledge. We invested $1.310 billion today, and I'm not aware that we had ever been over a billion before. And, that's a pretty good, for a kid from Raton, that's a lot of money. Anyway,
I think for most New Mexicans, that's.
We might have beat that number once. I'll look.
Okay.
We might have.
Maybe, there's not a doubt in my mind, I mean.
We didn't beat the hours we spent there.
Well, and the other thing, Madam Chair, last thing, I realize we can go, but I think what we should do is figure out a way to make everybody pretend we've been here for 3 hours before we do the investments, because that's the fastest we've ever been through 9 investments ever.
So, you know, Brent, if you could carry on the congratulations back to your team from this council, we are.
And I'm glad you emphasized team. It's a small part of me, very large part of my team. They've been around for a while. They're reliable. They work hard every single day, and I can't say enough good things about them. Really.
You lead by example.
Thank you.
Okay. All right, we've got, some new business before the council. Do we want to go over the 2024 meeting schedule, or just?
No, Madam Chair, that is in your packet, and you should review it.
I'm gonna have the secretary chair next time.
Just please look at it and check your calendars for next year, but it's the standard,
Hope this is
structure we currently have,
be reappointed.
fourth Tuesday of the month.
Maybe not.
In terms of appointment of a new SIO and a formal vote on that is upcoming.
I just have a couple of comments to make. Okay, so yes, we will look, in the next week and a half, we will have a formal vote and then get back, and we'll have that in a public meeting with a closed session. Two other things, are looking at an evaluation process, because evidently that has not been done for some time, of the council evaluating each year this new state investment officer, and also looking at an onboarding process to make sure that the new state investment officer meets the staff, meets the council members one-on-one, and also the appropriate legislators and people like that. And then lastly, we're also, which came out of comments, looking at a DEI policy for the State Investment Council. So those are all, the governance committee, and I'm working with staff on.
I appreciate you taking that on, Madam Chair. Thank you.
Pardon?
I appreciate you taking that on.
I just wanted to add to that. I'm going to be reaching out to the council members. I've heard from a couple of people regarding the special meeting we're shooting for. Hopefully next week. I think we're kind of gravitating towards Friday before 11, I think, because of a couple schedules. But I'll reach out to you probably today, if not tomorrow. If you could get back with me and just let me know if that time, 9 to 11, is probably not going to be much more than an hour. If that works, it'd be really appreciated, so we can get a scheduled in notice.
So Friday a week, not
Yeah.
Friday the 8th, between
Friday
9 and 11 Mountain Time.
Okay.
Yeah.
Yes.
Yeah.
Okay. On that, all right, our next SIC meeting is going to be January 23rd, 2024, in Santa Fe, because we do not have a meeting in the December month. And now we're going to public comment. Mr. Wallman, did anyone sign up to give public comment?
Madam Chair, I believe we do not have public comment today.
Okay, and with that, we will take a motion to adjourn.
Happy holidays to everybody. Can we say that now, even though it's a little early? And I move we adjourn.
Happy holidays.
All right, great.
Happy holidays.
Happy holidays.